Starting with the revisionary test paper of SFM CA final November 20 examination. Let us start with the revisionary test paper. Question number 1. The first question says that today being 1st of January 2019, RAM is considering purchasing of an outstanding corporate bond having face value of rupees 1000. So the security is provided as corporate bond, face value is 1000 rupees. That was issued on 1st of January 2017, which has 9.5% annual coupon and 20 years of original maturity, that is maturing on 31st of December 2027. Since the bond was issued, the interest rates have been, this is important, downside, as N is now currently selling at a premium of rupees 125.75 per bond. So the rate of interest in the market has gone down. So this security is selling at a premium. How much premium? 125.75. So we understand it is 1000 plus 125.75. That is the price of the security. Determine the prevailing interest on the similar type of the bond if it is held till the maturity, which shall be at par. So the question says that determine the prevailing interest on the similar bond means what sort of return that must be going on for this kind of securities in the market. In short, what is the yield of this security if at all somebody is purchasing the security today? That is the question. Present value factors have been given to us, year 1 to year 9 at the rate of 6% and at the rate of 8%. This is what we understand. So I am writing over here, say the answer of the question. We have been provided with the security that is a bond, or in a simple language it is debenture, which has face value of rupees 1000. Rate of interest is 9.5%. Redemption value is equal to the face value, that is again rupees 1000. Information is given that the current price is at 125 rupees premium. Precisely it is 125.75. So the price of the security is at premium. We have been provided with the information that price of the security is at 125.75 paise premium. So the total price would be rupees 1125.75. That is the price of the security. Let us understand further. It has been provided that it is going to have the maturity on 31st of December 2027 and today's date is 1st of January 2019. So we have been given today's date is 1st of January 2019 and date of redemption is 31st of December 2027. Today's date is 1st of January 2019. So as far as the number of years are concerned, we can say that's the 2019, 2020 and 7 more years. So the number of years are 9. Always for an existing security, we will take into account the remaining number of years for the purpose of calculation of answer. Now this kind of information is given to us for doing answer. Let us see that's how to make the calculation of answer with respect to the yield to maturity. Now friends, over here we can see that the rate of interest is 9.5% flat. So for the purpose of calculation of the return, either you can apply the approximate formula or you can go with the IRR method. Since the discounting factors information have been given to us, it means implied that say we are required to go with the IRR method for the purpose of doing answer. This is what we understand. So I am writing a note for the answer and then I am doing answer. First point, in this question, we are required to find yield to maturity for the security, comma, taking into account information provided. Full stop. Second point, we have been provided with discounting rate information. So we will calculate internal rate of return, comma, for finding yield to maturity. So we'll make the computation of the IRR. So working note number 1, calculation of P0, comma, using cost of capital 6%. So at 2 discounting rates will make the calculation. One is at the rate of 6% as provided to us. So year 1 to year 8 and 9th year. We'll show the interest income. What is the face value of the security? Face value is 1000. And what is the rate of interest? The rate of interest is 9.5%. So 1000 into 9.5%, that comes to 95. It is year 1 to year 9. Redemption value of the security, it is 1000 rupees at the end of 9th year. Net cash flow, 95 for first 8 years and for the last year it is 1095. Discounting at the rate of 6% and then present value. Discounting factors information have been given. First year factor is 0.943, second year is 0.89, 84, 792, 747, 705, 665 627, it comes to 6.209, 6.209, 6.209. Last year factor is 0.592, it is 0.592. So what will happen? 95 into 6.209, the present value is 589.86. (1095) into 0.592, 648.24. So using 6% as discounting rate, the price of the security is 589.86 plus 648.24, it comes to 1238.10. Okay. So at the rate of 6%, this is the price. However, the actual price of the security is provided as 1125. So what happens, let's say for the purpose of reducing the price, we are required to increase the cost of capital. Hence, we will make the computation of revised price at the rate of 8%. Working note number 2. Calculation of P0 at the rate of 8%. Year 1 to year 8 and 9th year once again. Net cash flow 95 and 1095. Discounting at the rate of 8%. Will compute the present value. Okay. Once again, year 1 to year 8. Factors are 0.926 plus 857 plus 794 plus 735, 681, 63 paise, 0.583 plus 0.54, that is 5.746. Last year factor is 0.50. This is 0.50 and this is 5.746. Into 95, that comes to 545.87. 1095 into 0.5, 547.50. So the total comes to 1093.37. This is the new P0. Okay. So now we have got two P0s. One is at the rate of 6%, whose present value is more, and another is at 8%, whose present value is less. So now we will do a kind of interpolation to calculate the final answer. So cost of capital 6%, cost of capital 8%, present value of the cash inflow, that is what we understand is the P0. It is 1238.1. 1238.1 at the rate of 8%, 1093.37. With the increase in the cost of capital, price is falling down. The cost of capital increases by 2%. Price reduces from 1238.1 to 1093.37. So it reduces by 144.73. For the purpose of calculating answer, you can take the base of either 6% or 8%. Usually I suggest to take the base of the lower one. So it is 1238.10 minus 1125.75. 1125.75. 1238.1 minus 1125.75. So that difference comes to 112.35. So it is reflected by this much change in the cost of capital. So it is 112.35 divided by 144.73 multiplying with 2%. So it comes to 1.56% or 1.55%. So the final answer is 6% plus 1.55, that comes to 7.55%. This is what's the return that this security has, and similarly other securities would be having this return. Now friends, if at all we would not have been provided with the factors information, then in that case you can calculate the yield to maturity by applying a simple formula like this. Annual interest income plus redemption value minus purchase price divided by n whole divided by redemption value plus purchase price divided by 2. This is what you can do. What is annual income? It is 95. Redemption value is 1000 minus what is the current price? 1125.75 divided by 9 years whole divided by average, that is 1000 plus 1125.75 divided by 2. This is the simple way by which you can calculate the answer if at all you have not been provided with the discounting factors information. So 1000 minus 1125.75, so it is of course 125.75 divided by 9. So it is 13.97. 95 minus 13.97. 1000 plus 1125.75 divided by 2. 1062.875. So 95 minus 13.97 divided by 1062.875, that comes to answer as 7.62%. So you can see that the actual answer is also very near to this answer, and of course it is going to be like this only because this will give us an approximate idea about the return. Next, let us see the question. The following data is available for NNTC bond. Bond means in simple language it is the debenture only. Face value is 1000. Coupon rate is 7.5%, means the rate of interest. Years to maturity is 8, so there are 8 years left for the maturity. Redemption value is 1000. Always remember that say for any existing security, the number of years which have been expired so far is always irrelevant. The number of years which are remaining is only relevant. Yield to maturity is at 8%. The first question is calculate the current price, duration and volatility of the bond. So there are 3 questions which are required to be answered. First is P0, second is the duration, and the last is the volatility. These 3 things are required to be found. Let us see that's how to make the calculation of the second question answer. Answer for the second part of the question. In that, calculation of P0, comma, duration and modified duration. Dear students, the term modified duration means nothing else but it is also called volatility, which is asked to us in the example. So how to make the computation of answer? Let us see. First of all, I am doing calculation of P0 and duration. I am doing both of them together. The question is providing that say there are 8 years to the maturity. Dear students, as we are required to find the duration, so we don't have a choice but to prepare a small cash flow series for the purpose of doing answer. So we will have the column number 1 as year 1 to year 8. Cash flow. There will be interest income for the first 7 years, and in 8th year will receive not only the interest income but also the redemption value. Discounting 8%, that is the rate which is given to us in the question, because over here it has been given that right now yield to maturity is 8%. Cash flows into present value factor. Product of both of them is a present value. Now based on the present value, you will compute the proportion. So you will get the weight or proportion. Weight or proportion into year. For the first year proportion, that is year 1. Second year proportion, year 2. That is the way we will make the computation of the year into weight or proportion. And the total of that is what we understand is the simple duration of the answer. And so when we make the computation of the total of the present value, then automatically P0 will be calculated. This is the simple thing that you are required to do. My observation is that say when a student is told about this procedure, the student is very well able to understand it, how to do it. However, number of times students do not do practice of these questions. So my suggestion is to make sure that say you are doing proper practice also for this kind of questions. Only in that case in examination you will be able to write the answers of the question without any botheration. So my suggestion is to have the writing practice. So over here first year will receive the interest income 1000 rupees into 7.5%. It comes to 75. So the first year income is rupees 75. Second year again 75. Third year again 75. Fourth year 75. Fifth year 75. Sixth year is again 75. Seventh year it is again 75. Eighth year, friends, we will receive not only 75 but also the redemption value of the security. Redemption value is provided as 1000 rupees, that is the face value of the security. Very good clarification is made in the question. Even otherwise we make that kind of assumption usually. If at all directly or indirectly no information is given in that case. Discounting of the cash flow series at the rate of 8%. First year factor is 0.9259. Second year factor is 0.8573. Third year it is 0.7938. Fourth year it is 0.7350. Fifth year it is 0.6806. Sixth year it is 0.6302. 7th year it is 0.5835. Last year 0.5403. Okay. So we'll make the computation of the present value of the cash flow. 75 into 0.9259, that comes to 69.44. Next, 75 into 0.8573, so it comes to 64.30. 75 into 0.7938, 59.54. 75 into 0.735, 55.13. 75 into 0.6806, 51.05. 75 into 0.6302, 47.27. 75 into 0.5835, 43.76. 1075 into 0.5403, it is 580.82. That is the way we will compute the P0. So over here 69.44 plus 64.3 plus 59.54 plus 55.13 plus 51.05 plus 47.27, next 43.76, and the last 580.82. So it is 971.31. That is the way so the current price can be calculated. Then we will compute the proportion. Friends, proportion will be calculated as the present value of the cash flow divided by P0. 69.44 divided by 971.31. So 0.0715. $64.3 divided by P0, 0.0662. 59.54 divided by P0, 0.0613. 55.13 divided by P0, 0.0568. 51.05 divided by P0, 0.0526. 47.27 divided by P0, 0.0487. 43.76 divided by P0, 0.0451. 580.82 divided by P0, 0.5980. Yet friends, we are required to make a total of this. The total of this has to be 1. If it is not 1, then in that case we are required to do the adjustment in the last value. 0.0715 plus 0.0662 plus 0.0613 plus 0.0568 plus 0.0526 plus 0.0487 plus 0.0451 plus 0.598. Okay, so this value is exceeding 1. So we will make the adjustment, say for the last value, minus 0.598 minus 1. So it is 0.5978. So this is found as balancing figure, and the total will be of course 1. Now the last thing, weight into proportion, weight into year. So it is 0.0715 into 1, 0.0715, 0.0662 into 2, 0.1324, 0.0613 into 3, 0.1839, 0.0568 into 4, 0.2272, 0.0526 into 5, 0.2630, 0.0487 into 6, 0.2922, 0.0451 into 7, 0.3157, 0.5978 into 8, that comes to 4.7824. That's it. We'll make the total of this. It is 6.2683. And this is considered to be the duration of the security. Just let us take the calculation. 0.0715 plus 0.1324 plus 0.1839 plus 0.2272 plus 0.263, 2922, 3157, 4.7824. Yes. So this is the way the duration of the security is calculated. Yet the answer is not over. The question says that to compute the volatility of the bond. Volatility or modified duration is one and the same thing. It is indicating that say for every 1% change in the cost of capital, what would be the percentage change in the price of the security. So we understand that so the volatility is calculated as negative duration divided by 1 plus k. Because we understand that so with the increase in the cost of capital, price will fall down. With the decrease in the cost of capital, the price will go up. So it is negative 6.2683. Negative 6.2683 divided by 1.08. Why? Because the cost of capital is 8%. Okay. So 6.2683 divided by 1.08. So it is negative 5.8040. Negative 5.8040%, or we can write 5.8 also. So this is what say we have the volatility or modified duration. Next question. Calculate the expected market price of the share security bond over here if decrease in the required yield by 50 basis points. So over here the question says that if at all the required rate of return reduces by 0.5%, then in that case what would be the revised the price of the security? That is what say we are required to compute over here. Means over here the discounting rate is decreasing. With that we are required to find the revised P0. So answer of the second part of the question, calculation of revise the P0. We can say that it is current P0 plus increase in the price. Because we understand that the discounting rate and the price of the security have inverse relationship. So if at all the required rate of return is decreasing, the price of the security will go up. What is the current price of the security? It is 971.31. So 971.31 plus 971.31 into, now volatility rate is 5.8040. So for increase in the cost of capital, the price will fall down, and with the decrease in the cost of capital, price will go up. What is the rate? 5.8040. 5.8040% into what we will do, 0.5. Why? Because there is a reduction in the cost of capital by 0.5%. So 971.31 plus 971.31 into 5.8040% into 0.5. It comes to 28.19. So 28.19 plus 971.31, it comes to 999.5. It comes to 999.5, or we can say that it is very near to rupees 1000. This is the way the revised price of the security can be calculated. Now, before making this calculation, you should have understood that the answer is bound to be equal to the face value of the security. Why? The reason for that is very simple. The required rate of return is right now 8. From 8 it reduces to 7.5. So what happens at the rate of interest and the required rate of return are same, plus redemption value of the security is equal to the face value of the security. If at all it is like this, then the price of the security will be equal to the face value of the security. What is the face value of the security? 1000. This is also the way you can give answer for this only question, because every time you will not be provided with such information with which you can do the answer. One more thing, over here, instead of making the calculation of answer using the volatility, what you can do, you can make the computation like this: year 1 to year 8, or year 1 to year 7 and 8th year. Will show the interest income. What is the rate of interest? The rate of interest is provided to us as 7.5%. So interest income is 1000 into 7.5%. That comes to 75. Year 1 to year 8. Okay, which we already have calculated, and last year it is 1075. Okay, this is already what we have done. Now discounting at the rate of 7.5. Why 7.5? Because the required rate of return reduces. That is the reason. 1, 2, 3, 4, 5, 6, 7. 1 to 7 factor summation is 5.2966. One, 2, 3, 4, 5, 6, 7, 8. 0.5607. Now using this we compute the present value. 75 into 5.2966. 397.25. 1075 into 0.5607. 602.75. 397.25 plus 602.75, it comes to exactly 1000. So this is also the way you can compute the answer regarding the price of the security with the decrease in the required rate of return. Next question is, Question number 3. It is a question from the chapter of portfolio management. A study by a mutual fund has revealed the following data in respect of 3 securities A, B and C. Standard deviation is given for each of the security. Correlation with index, that is R correlation coefficient, is provided to us between security and the market portfolio. Standard deviation of the market portfolio BSE Sensex is 15%. The first question is, what is the sensitivity of returns of each stock with respect to the market? And so on, further questions are provided to us. Now, what is the question? The question is that you are required to make the computation of the beta of the security. Yes, the term sensitivity stands for the beta, because we understand that the beta is measuring that with the change in the market portfolio return, what would be the change in the return of the security. So we are required to compute beta in the first part of the question. Let us see that how to make the computation of the beta of the security. So calculation of beta of security. Beta of the security will be calculated by using the formula as correlation coefficient into standard deviation of security divided by standard deviation of market portfolio. That is the way we will make the computation of the beta of the security. So over here it is required to be calculated for 3 securities A, B and C. So column number 1 is security, it is A, B and C. Then beta will be calculated correlation coefficient into standard deviation of security upon standard deviation of market portfolio. Now correlation coefficient is provided 0.6, 0.95, 0.75. So it is 0.60, then 0.95 and then 0.75. Multiplying with the standard deviation of the security 20, 18 and 12. So it is 20, 18 and 12 divided by standard deviation of the market portfolio. What is standard deviation of market portfolio? It is 15%. So divided by sigma m is 15. That's it. That is the way we are required to make the computation of the beta of the individual security. So we understand that it is 0.6 into 20 divided by 15. That comes to 0.80. 0.95 into 18 upon 15. That comes to 1.14. Then 0.75 into 12 upon 15. That comes to 0.60. That is the way beta can be calculated for individual security. So this is the way the beta of the individual security can be calculated as R into standard deviation of security upon standard deviation of market portfolio. Next question. What are the covariances among the various stocks? So we are required to find the covariance between A with B, A with C and B with C. That is the way we are required to find the covariance. Now dear students, for the purpose of calculation of the covariance, That is the second part of the question. We understand like this. Second part of the question, covariance. Let us see that, say, how to make the computation of answer. Basically, for the purpose of covariance between A and B, we have a simple formula as summation of A minus A bar into B minus B bar divided by number of observations. This is the formula that you can apply, or otherwise it is covariance between A and B is equal to probability into A minus A bar into B minus B bar summation of the same. That is the way the covariance is calculated. However, we can see that the sufficient information is not given with which we can apply this formula. So what we will do, listen carefully, we will work out the answer something like this. As far as the covariance between A with B is concerned, in order to compute that, we will take into account the formula that we use for the correlation coefficient. So we are required to use one of the formula that we have studied as correlation coefficient. We know that the correlation coefficient between A and B is calculated as covariance of A with B divided by standard deviation of A into standard deviation of B. This is the formula which is required to be applied. Now, covariance between A with B is equal to correlation coefficient of A with B into standard deviation of A into standard deviation of B. This is the formula to be applied. You can see that the standard deviation of A information is given, it is 20%. Standard deviation of B is given, it is 18%. However, the correlation coefficient between A with B is not given. No problem. Correlation coefficient of A with M and B with M is given. So what we will do, friends, we will make the calculation of answer like this. Correlation coefficient of A with M into correlation coefficient of B with M into standard deviation of A into standard deviation of B. This is the formula which is required to be applied. Using this formula, we will make the calculation of the covariance between A with B. And so on, we are required to do further answer. Hence, we understand that the covariance of A with B, finally it is correlation coefficient of A with M into correlation coefficient of B with M into standard deviation of A into standard deviation of B. That is the simple formula to be applied. Now, R of A with M is 0.60. B with M is 0.95. Into standard deviation of A is 20 and standard deviation of B is 18. So this is 20 and this is 18. So the final answer is 0.6 into 0.95 into 20 into 18. That comes to 205.2. So covariance between A with B is 205.20. Then A with C, covariance of A with C, the same logic is applicable. So what will happen over here? Correlation coefficient of A with M into correlation coefficient of C with M into standard deviation of A into standard deviation of C. This is the way we will make the calculation of answer. R between A and M is 0.60. R between C with M it is 0.75. Standard deviation of A, it is 20 and standard deviation of C is 12. So this is 20 and this is 12. So 0.6 into 0.75 into 20 into 12, it comes to 108. Next is covariance of B with C. Again, correlation coefficient of B with M into correlation coefficient of C with M multiplying with standard deviation of B multiplying with standard deviation of C. Again, this formula is to be applied. Correlation coefficient is 95/75. So this is 0.95, this is 0.75. Standard deviation is 18 and 12. This is 18% and this is 12%. 0.95, 0.75, 18, 12. That is 153.9. So finally, we will have the covariance matrix like this. We can write security A, security B, security C. Security A, security B, security C. We understand that say we have computed covariance between A with B 205.2. This is 205.2. A with C, it is 108. B with C, 153.9. Dear students, writing like this or otherwise, you can mention in this way also. A with B, it is 205.2. Again, A with C, it is 108. B with C, 153.9. This is the way you can write. These two things are always going to be opposite to one another. Now, these values are nothing else but it is the variance of security A, security B and security C. So, calculation of variance of A is equal to standard deviation of A into standard deviation of A. A security standard deviation is 20%. So it is 20 into 20. That comes to 400. Variance of B, it is standard deviation of B into again standard deviation of B. So it is 18 into 18. That is 324. Then variance of C, standard deviation of C into standard deviation of C. So it is square of 12. That comes to 144. So over here we understand that say this is 400, this is 324 and this is 144. That is the way we can have say this entire matrix. After making calculation of the covariance matrix, let us see the next question. What would be the risk of the portfolio consisting of all the three stocks equally? So we are required to make the computation of the risk of the portfolio if equal investment is made in all the three securities. The next question is, what is the beta of the portfolio consisting of equal investment in each stock? Let us see how to make the computation of the risk of the portfolio. Dear students, there are three securities in which the investment is made. So what will happen, we understand that say variance of the portfolio is equal to WA square sigma A square plus WB square into sigma B square plus WC square sigma C square plus 2 into R into standard deviation of A into standard deviation of B multiplied with weight of A into weight of B plus 2 into R into standard deviation of A, standard deviation of C, weight of A into weight of C, 2R standard deviation of B, standard deviation of C, multiplying with weight of B into weight of C. Of course, friends, we understand that over here R is required to be taken between AB, over here AC, and over here BC. That is the way we are required to take the R value. Now let us see how to make the calculation of answer. WA square, that is weight of A is 1 by 3 raised to 2. Weight of B is again 1 by 3 raised to 2. Weight of C is again 1 by 3 raised to 2. So it is WA square, WB square, WC square. Variance of A, we have been provided with the standard deviation information 20, 18 and 12. So it is 20 raised to 2, 18 raised to 2 and 12 raised to 2 plus 2 into R. R between A and B is not provided. However, we can say that say the multiplication of this 3 is nothing else but it is the covariance which we have. Multiplication of this 3 is nothing else but it is the covariance. Again, multiplication of this 3 is the covariance, that is R into standard deviation of A into standard deviation of B. And covariance between A with B has already been found by us. It is 205.2. So it is 205.2 multiplying with weight of A into weight of B, that is into 1 by 3 into 1 by 3 again. Next, 2 into covariance between A and C. A and C covariance is 108. So 2 into 108 into 1 by 3 into 1 by 3 again. Next, 2 into covariance of B with C. B with C covariance is 153.9. So over here it is 153.90 into weight of B into weight of C. That's it. This is the way we will have set the formula. So 1 by 3, that is 0.33, its square into 400, because square of 20 is 400. So it is 44.44 plus 1 by 3, 0.33, its square 0.11 multiplying with square of 18. It comes to 36. Plus square of 12 into square of 1 by 3, it is 16 plus it is 2 into 205.2 into 0.11, that is 45.60. Next, 2 into 108 into 0.11, that comes to 24. 2 into 153.9 into 0.11, that is 34.20. So the total will be calculated as 44.44 plus 45.60 plus 36 plus 24 plus 16 plus 34.2. It comes to 200.24. Once we compute the variance, afterwards we will make the computation of the standard deviation. Standard deviation is calculated as under root of the variance. So it is under root of 200.24. So it comes to 14.15%. That is the standard deviation of the portfolio. Okay. Next, the question says that compute the beta of the portfolio consisting of the equal investment in each stock. Dear students, beta of the portfolio is calculated as simple weighted average, the proportion in which you have made investment multiplying with the respective beta. That is the way the beta of the portfolio can be calculated. That is answer of the fourth part of the question. So answer of question number 4, in which calculation of beta of portfolio. So we'll take into account the weight. First of all, it is the security, then the weight in which the investment is made, beta, then weight into beta. There are 3 securities A, B and C. Weight is 1/3, 1/3 and 1/3. Beta has also been provided to us. That is, we have calculated rather. That is the beta of the security in the very first part of the question. It is 0.8, 1.14 and 1.60. Like that, so the beta multiplying with the weight, that is the way the weighted average calculation will be made, as we do in case of return of the portfolio, as we do in case of weighted average cost of capital at our IPCC or intermediate level. So the weight of A security is 1/3 and its beta is 0.8. For the second one, the beta is 1.14, and for the last one, beta for C security is 0.60. So now weight is 1/3, 0.8 into 1/3, it comes to 0.2667, 1.14 into 1/3, 0.38, 0.60 into 1/3 is 0.20, so 0.84167. This is the way the beta of the portfolio can be calculated. So beta of the portfolio is simple weighted average. It is 0.8467. Next, what is the total systematic and unsystematic risk of the portfolio in part 4? That is a question. It means that the total risk of the portfolio is required to be bifurcated into systematic risk and unsystematic risk. So friends, we understand that the total risk of the portfolio is divided into 2 parts, systematic risk and unsystematic risk. So answer for the 5th question, total risk of portfolio which is measured in terms of the variance, it is 200.24. So it is 200.24. That is divided into 2 parts, One is systematic risk and another is unsystematic risk. Systematic risk is beta square into sigma m square. Coincidentally, we have the beta information 0.8467 square multiplying with the variance of the market portfolio. As far as the market portfolio is concerned, its standard deviation is 15. So the variance will be calculated as square of 15 to 25. So 0.8467 its square into square of 15, that comes to 161.30. As far as the unsystematic risk is concerned, it is calculated as total risk minus systematic risk. Total risk is 200.24. Systematic risk is 161.30. 200.24 minus 161.3, it comes to 38.94. That is the unsystematic risk of the portfolio. This is the way we are required to make the computation of the bifurcation of the total risk into systematic risk and unsystematic risk. Next question, question number 4. Mr. Abhishek is interested in investing rupees 2 lakhs, for which he is considering following 3 alternatives. So an investor wants to make investment of 2 lakhs and he is considering 3 options. The first is to invest an amount of 2 lakhs in the mutual fund X. Second is to invest 2 lakhs in the mutual fund Y. The third is to invest 1,20,000 in X and 80,000 rupees in Y. So the first is you make investment in a single security. Second is again you make investment in a single security. Third is you make an investment in a combination of security X and Y. Average annual return earned by mutual fund X, mutual fund Y is 15% and 14% respectively. So X has earned a return of 15, Y has earned a return of 14. Risk-free rate of return is 10, RF is given. Market rate of return is 12, that is RM is given. Covariances of the returns of mutual fund X, mutual fund Y and the market portfolio mix are as follows. So we have been provided with this covariance mix. This is X with Y, this is X with market and this is Y with market. As what we have discussed in the previous question, this information is useless because it is exactly the same that we have over here 4300. This information is useless because it is the same that 3.37 that we have over here. Again this information is useless. And so this is what we understand is the variance of X, variance of Y and variance of Z. Okay. You are required to calculate variance of the return from mutual fund X, mutual fund Y and the market return. The first question answer has been provided to us ready-made in the question. What is the variance of the mutual fund X? We can say its answer is 4.80. We can say that its answer is 4.25. And lastly, so its answer is 3.10. That is the way we can compute the variance for X, for Y and for market portfolio. The second is calculate the portfolio return. Next, beta. Third, portfolio variance and portfolio standard deviation. So simply we are required to make the computation of the basic details about both about the 3 portfolios in terms of the return, in terms of the beta, in terms of the variance and set the portfolio standard deviation. So now understanding that how to do answer. For the first part of the question I am dictating a precise answer And for second part of the question, importantly, how to do answer that we are discussing. See, the question is clearly providing that say for the portfolio you are required to find the return. Now we know that say the return of the portfolio is simple weighted average. We will compute that say what is the proportion in which the investment is made in mutual fund X and mutual fund Y. We will make the computation of the proportion, and then we have been provided with the returns 15% and 14%. So we will calculate the weighted average of the same, that is return of the portfolio. Next, beta. Again, beta of the portfolio is simple weighted average. So we will compute beta for the security X, beta for the security Y using this information provided to us. Because you have been provided with the information about the covariance matrix. So over here, security X or the mutual fund X with the market portfolio. Then mutual fund Y with the market portfolio. This and variance of the market portfolio will be taken into account to compute the beta and then weighted average. This is a sequence in which we have to do answer. So let us start with the answer. Answer of question number 4. Yes. Answer of question number 4. In that, the first question is compute the variance of the return for X, Y and market. So answer of the first question, in that calculation of variance of X, Y and market portfolio. These three things are required to be calculated. X, Y and market portfolio. We will mention the variance for security X. The variance is provided to us ready made. For X it is 0.80. For X it is 4.80. Then for Y it is 4.25. And for market portfolio it is 3.1. So this is the way we are required to compute the variance. Next, second part of the question, which is quite important according to me. For the portfolio you are required to make the computation of these answers. So second part of the question. In that, first of all, a working note for computing the weight. That is working note number 1. Calculation of Wx and Wy. Wx is amount of investment divided by total. What is the amount of investment? Amount of investment is 1,20,000 in X out of rupees 2 lakhs. That comes to 0.60. Then weight of Y. It is again amount of investment divided by total. Investment is made in security Y 80,000 divided by total is 2 lakhs. So it comes to 0.40. That is the way we'll compute the weight. Okay. Then the question says that you're required to make the computation of return of the portfolio. So we can say that calculation of return of the portfolio. In that, column number 1 is security, column number 2 is weight, column number 3 is return, which is again provided to us, then weight into return. That is the way the weighted average will be calculated, that is return of the portfolio. So there are two securities in which investment is made, X and Y. What is the weight? Weight is 0.6 and 0.4. Total is 1. The returns have been provided to us. It is 15% for the first one and 14% for the second one. So this is 15 and this is 14. So 0.6 into 15, that is 9. 0.40 into 14, that is 5.6. That is the way the return of the portfolio can be calculated. 9 plus 5.6, that is 14.6. This is the way the return of the portfolio can be calculated as 14.6%. Next, the question is providing the information that compute the beta of the portfolio. Dear students, beta of the portfolio is simple weighted average, and for that, first of all, we will make the computation of the beta of the individual security, and then again the simple weighted average is beta of the portfolio. So now, calculation of beta for X and beta for Y. How it is calculated? It is covariance of security with market divided by variance of the market portfolio. This is the way you can apply the formula, or otherwise we understand as the correlation coefficient of the security with market into standard deviation of security upon standard deviation of market portfolio. Either of the formula that can be applied for the purpose of doing answer. So over here, security X for that beta, you can see, dear students, that information is provided to us regarding the covariances of X with M. It is provided to us as 3.37. So covariance of the security with market divided by sigma M square. So it is 3.37 divided by the variance of the market portfolio. For the market mix, the variance is provided to us as 3.10. So divided by 3.10. Similarly for mutual fund Y with market portfolio is 2.8. So it is 2.8 divided by 3.1. So 3.37 divided by 3.1. It comes to 1.087. 1.0871. And for the next one, it is 2.8 divided by 3.1. So 0.9032. That is the way, so the beta of the security can be calculated. Beta of the individual mutual fund. Afterwards, calculation of beta of the portfolio, which is again simple weighted average. Security / mutual fund, weight in which the investment is made, multiplying with the beta, weight into beta. Accordingly, answer will be calculated. So security of mutual fund X weight is 0.60, beta is 1.0871. So it is weight into beta, 0.6 into 1.0871, that is 0.6523. For y, it is 0.40, then it is 0.9032. So weight into beta once again. So it is 0.4 into 0.9032. So 0.3613. That is the way the beta of the portfolio can be found. 0.6523 plus 0.3613. So it is 1.0136. That is the beta of the portfolio. Next, the question says that you are required to compute portfolio variance and then standard deviation. Okay, so we are required to compute the variance of the portfolio. Calculation of sigma p square. Again, very simple formula. We understand it is wx square sigma x square plus wy square sigma y square 2r standard deviation x standard deviation y into wx wy. Security x, the weight is 0.60, so 0.60 raised to 2. Security y, it is 0.40 raised to 2 into variance of x. As far as the security x is concerned, for that, so the variance is 4.8 and security y is concerned, for that, so the variance is 4.25. That is the way security x and security y, we can take the variance, then 2 into r into standard deviation x standard deviation y, that is nothing else but it is covariance. So the covariance between x with y is provided to us as 4.30. So plus 2 into covariance of x with y, it is provided as 4.30 that is multiplication of this 3 value, multiplying with weight of x is 0.6, multiplying with weight of y is 0.4. Okay, so now it is square of 0.6 into 4.8, that comes to 1.728 plus square of 0.4 into 4.25, that is 0.68 plus 2 into 4.3 into 0.6 into 0.4, that comes to 2.064. (1.728) plus 0.68 plus 2.064. So the variance is 4.472. And based on that, we will compute the standard deviation. Standard deviation is under root of the variance. So it is under root of 4.472. And that comes to 2.1147. That is the way the standard deviation of the portfolio can be found. Next question. The question says that compute the expected return, compute the systematic risk and unsystematic risk. These three things are required to be calculated. Friends, over here we understand that in the third part of the question only says that compute the return, systematic risk, unsystematic risk. So over here it is implied for us to understand that we are required to do the calculation for all the three, that is for X, for Y and for portfolio. In addition to that, we understand that the question is ready-made providing the return information to us. Even though the return information is given to us, the question says that you compute the return. What does it mean? It means that you are required to compute the required rate of return taking into account the beta of the security. That is, by using the CAPM, we are required to calculate the answer. So over here, say in the third part of the question, we'll compute the return from X, we'll compute the return from Y, we'll compute the systematic risk and unsystematic risk for X, for Y and for the portfolio. That is the way we are required to do this simple answer. So answer of the third part of the question, in that calculation of required rate of return based on CAPM. So it will be calculated as RF plus beta into RM minus RF. This is the way we'll apply the simple formula. We'll do it for X mutual fund, we'll do it for Y mutual fund and we'll do it for the portfolio. That is the way we are required to do answer. For X mutual fund, we understand that the risk-free rate of return which is provided to us in the question is 10%. So the risk-free rate of return is 10 plus beta for the security X. It is 1.0871. 1.0871 multiplying with the return on the market portfolio, which is 12%, minus RF is 10. So what will happen? 12 minus 10, that comes to 2 into 1.0871. 2.1742 plus 10, that comes to 12.1742, or we can write over here 12.17%. That is the way we can compute for X, similarly for Y and then for portfolio. Now for security Y or mutual fund Y, it is 10 plus beta is 0.9032 into 12 minus 10. So what will happen? It is 2 into 0.9032, whatever the answer, plus 10. That comes to 11.81. For the portfolio again, 10 plus beta of the portfolio is 1.0136. 1.0136 into 12 minus 10. 1.0136 into 2 plus 10, that comes to 12.03%. This is the way we can compute the return. Dear students, in order to compute the return of the portfolio, if at all you take the weighted average of these two returns, even in that case you will get the same answer. That is, just I am explaining to you You can do answer by either of the method. Return of the portfolio is weight of X into return of X plus return of Y into weight of Y. 60% investment is made in security X, which has a return of 12.17%. 40% investment is made in Y, which has a return of 11.81%. 0.6 into 12.17, that comes to 7.30, plus 0.4 into 11.81, that comes to 4.72. So 7.3 plus 4.72, that comes to 12.02%. This is the way the return of the portfolio you can compute by either of the method. Okay. Going one step ahead, the question says that you are required to calculate the systematic risk and unsystematic risk. It means, friends, that the total risk of the portfolio is required to be bifurcated into systematic risk and unsystematic risk. So now, calculation of systematic and unsystematic risk of security, portfolio. This is what we are required to calculate. So we'll do it for X, we'll do it for Y, and then we'll do it for the portfolio. As far as the total risk is concerned, total risk is measured in form of the variance. Let us see. As far as the security X is concerned, its variance is 4.80. For security Y, the variance is 4.25. And as far as the portfolio is concerned, its variance is calculated by us 4.472. Now we will compute the systematic risk. Dear students, systematic risk can be calculated as beta square into sigma m square. That is the formula to be applied. We have the beta information. We have the variance of the market information. Afterwards, the unsystematic risk is the balancing figure. That is the total risk minus systematic risk. So the systematic risk is beta square into sigma m square. Now for security X, what is the beta value? It is 1.0871. So it is 1.0871 raised to 2 into sigma m square. Now as far as the market portfolio is concerned, its variance is provided to us as 3.10. So multiplying with 3.10, so it is 1.0871 its square into 3.10, so 3.6635. So it is 3.6635. That is the systematic risk. The unsystematic risk is 4.8 minus 3.6635. 4.8 minus 3.6635. That comes to 1.1365. That is the unsystematic risk. Now for security Y, again we are required to apply the same formula. What is the beta for security Y? It is 0.9032. So it is 0.9032 its square into variance of the market portfolio is 3.10, friends. 0.9032 its square into 3.1, it comes to 2.5289. 2.5289. This is the systematic risk, and the remaining is unsystematic risk. It is 4.25 minus 2.5289. 4.25 minus 2.5289. It comes to 1.7211. Last, we understand that the systematic risk of the portfolio, in that case 1.0136 square, 1.0136 square into 3.10, 1.0136 square into 3.1, that comes to 3.1849. 3.1849. Then 4.472 minus 3.1849. 4.472 minus 3.1849. It comes to 1.2871. That is the way we can have the bifurcation of the total risk into systematic and unsystematic risk. Next, question is compute the Sharpe ratio. Fine. Trainer's ratio is also fine. Alpha for mutual fund X, mutual fund Y, and for the portfolio mix. Dear students, we know that the Sharpe ratio is indicating that what is the additional return from the security or from the portfolio for every 1 unit of additional risk that you undertake in that investment. In calculation of the Sharpe ratio, we take into account the total risk, that is risk measured in form of standard deviation. Whatever is the Sharpe ratio itself is the trainer's ratio, with the only change that the risk is measured in form of the beta of the security instead of risk measured in form of standard deviation. Alpha is calculated using the required rate of return as per CAPM and say actual return that the security is likely to generate based on either past experience or expected future growth. So there are three means, there are three methods by which we are required to do evaluation. So here, next question, I think that it is the question number 4. So answer of question number 4, in that calculation of Sharpe ratio, comma, trainer's ratio and alpha. These three things are required to be calculated. So we understand that it is investment, then Sharpe ratio. Sharpe ratio is calculated as X bar minus RF divided by standard deviation. For mutual fund X, let us see that how to make the computation of answer. We can see that for mutual fund X, the return is 15%. Risk-free rate of return is 10% divided by the standard deviation of the investment. So it is 15% minus 10% divided by standard deviation of X investment. As far as the security X or the mutual fund X is concerned, we can see that its risk is 4.8. That is the variance. However, over here we require the standard deviation. So it is under root of 4.8. Similarly, for Y, calculation will be made. For security Y or mutual fund Y, the return is 14%. So what will happen, dear students? 14 minus 10 divided by under root of 4.25. Yes, it is under root of 4.25. Then we understand that say for portfolio, okay, what is the return of the portfolio? That we already have computed as simple weighted average. Return of the portfolio is 14.6%. So we'll apply the same formula. It is 14.6 minus 10 divided by standard deviation of the portfolio. As far as the variance of the portfolio is concerned, it is 4.472. So it is under root of 4.472, that is the standard deviation. So now let us see calculation one by one. Root of 4.8, 5 divided by that value, it comes to root of 4.8, then 5 divided by standard deviation, it comes to 2.2822. We can write up to 2 decimal 2.28. Next, root of 4.25, then it is 4 divided by standard deviation 1.9403. Next, 4.472, it's under root. So 4.6 divided by standard deviation 2.1752. That is the way we'll make the computation of the Sharpe ratio for the individual investment. Similarly, we'll do the trainer's ratio calculation. We do not have to apply any ranking. We just have to make the computation of the Sharpe ratio for each of the investment. The next is calculation of the trainer's ratio. So next is calculation of trainer's ratio. For the purpose of calculation of the trainer's ratio, we'll take into account the beta of the investment. That is again X per minus RF, that is the additional return divided by beta of the security. We understand that say this is indicating the additional return for every 1 unit of additional risk. Why it is called every 1 unit of additional risk? Because the standard deviation of or the beta of the risk-free security is 0. So when you make investment in the security, then in that case the risk of that security is the additional risk that you undertake in your investment, and X per minus RF is the additional return that you get. I repeat the logic over here. We understand that over here it is 5 upon root of 4.8, it is 2.1909. See over here the logic is like this, that if at all as an investor I make investment in security X or mutual fund X, then in that case the additional return and additional risk. You make investment in X, what is the additional risk that you have? 2.1909. This is the risk that you take over the risk-free rate of return, and that is going to generate some additional return. How much? 5%. So for 2.19% risk, you get a return of 5. So for every 1 unit of additional risk, this is the additional return, and it comes to 2.28, and so on. So the calculation is made. So over here column number 1 is investment, column number 2 is trainer's ratio. It is calculated as X per minus RF divided by beta of the security. We start with the mutual fund Y. What is return of the mutual fund Y? It is 15% minus 10 divided by beta. Now what is beta of X? Beta of X is 1.0871. 1.0871. Similarly for Y, it is 14 minus 10 divided by, what is beta for Y? it is 0.9032. So divided by 0.9032, and the last one is portfolio. Return of the portfolio is, I think, 14.6 minus 10 divided by the beta is 1.0136. 1.0136. This is the way we are required to make the computation of answer. So it is 15 minus 10, that is 5, divided by 1.0871. It comes to 4.60. That is the trainer's ratio. 14 minus 10, that is 4, divided by 0.9032. It comes to 4.4287. Or we can say it is 4.43, simple. Next, 14.6 minus 10, that comes to 4.6, divided by 1.0136. It comes to 4.54. That is the way we are required to compute the trainer's ratio. We understand that the Sharpe ratio is taking into account the total risk, and the trainer's ratio is taking into account only systematic risk for the purpose of calculation of the additional return for every 1 unit of additional risk. Next is calculation of the alpha. So now, calculation of alpha for each investment. Investment alpha is calculated as x bar minus rj. So we'll do it for x, we'll do it for y, and then we'll do it for the portfolio. That is the way the answer will be calculated. For x, the return is 15, and for y it is 14. So this is 15, this is 14, and for portfolio it is 14.6 minus required rate of return, which again we have calculated earlier. Yes, here is the answer. It is 12.17. Next is 11.81, and the last is 12.03. So it is 12.17 for the first one, then 11.81 for the second one. That is the way the answer will be calculated. So it is 15 minus 12.17. So it is 2.83. 14 minus 11.81. It is 2.19. 14.6 minus 12.03. It is 2.57. This is the way we are required to compute the alpha. Over here, we just have to make the calculation of answer. We may be required that, say, you are required to rank the securities, you are required to rank the investment. Then the security having, say, the highest alpha will be given first rank, and so on. Similarly for trainer's ratio, similarly for Sharpe ratio, we may be provided that, say, you are required to rank the investment. Then of course we'll go from the highest to the lowest. Dear students, this question was asked by Institute in examination in November 2016, question number 4A, and it was asked for 8 marks. See, when I am writing over here November 2016, I hope that so all of you must have understood that it was asked in old syllabus. It is there in the old practice manual, October 2018 edition. In that, say the page number 7.33, question number 27. What I want to tell you is that regularly in the classroom, regularly in the Navkar lectures, we tell you that say doing the chapters which are common in the old syllabus and new syllabus, doing the questions from the old practice manual is very important. That will give you a practice. At the same time, say there are fair chances that the questions will be there say from those material of the institute directly in the examination. As far as the chapters which are common, for that say the old syllabus material and new syllabus material, that difference does not make any sense. Next question. Next question is from mutual fund. There are two mutual funds, namely D mutual fund and K mutual fund, each having close-ended equity schemes. NAV as on 31st of December 2019 of the equity scheme of D mutual fund is 70.71, consisting 99% of the equity and the remaining cash balance. K mutual fund 62.5, consisting of 96% of the equity and the remaining in cash. Following is the other information. Equity scheme information have been given to us for D mutual fund and for K mutual fund, wherein information is given about the Sharpe ratio, Trainer's ratio and standard deviation. There is no change in the portfolio during the next month. The annual average cost is ₹3 per unit for the scheme of both the mutual funds. If the share market goes down by 5% within a month, calculate expected NAV after a month for the schemes of both the mutual funds. For calculation, consider 12 months in a year and ignore the number of days for a particular month. Okay. Let us have understanding that say how to calculate answer of this question. Before I proceed further, again I would like to give you a clarification that say this was an example which was asked in May 2015 examination. It was question number 6B and it was asked for 8 marks. This question is there in your practice manual also. It is question number 39, October 2018 edition, and in that say page number 9.40. At the same time, dear students, say this question has been kept by the institute in the revisionary test paper for SFM new in May 2019, that is question number 5. This was asked in examination. Okay. Let us understand the important point of this question and we'll understand that's how to do this answer. See over here, I would say honestly from my end, I believe that say this question has two concepts. One concept that we have is the mutual fund, because the NAV net asset value is required to be computed. At the same time, say over here, we can say that say the question is having say the concepts of the portfolio management. Recently what we have studied, Trainer's ratio, Sharpe ratio, standard deviation, all those things are required to be used over here. How to make calculation of answer? Let us understand it. Of course, there are two mutual fund schemes information have been given. Whatever we do for the first one, that copy paste we have to do for the second one. That is nothing great about it. I would like to give you a detailed explanation for the first one. The second one is only a kind of repetition that we do. First of all, understanding that say what is the question about. The question says that the mutual fund D has NAV of 70.71. This 70.71 is the NAV. In that say we have the equity and debt, that is equity and cash balance. It has been given that say the 99% is in equity. So 70.71 into 99. It comes to approximately 70 rupees. So remaining 71 paise is in cash balance. We have been provided with the information that the share market is decreasing by 5%. Now, if at all the share market is decreasing by 5%, then in that case, there would be certain change in the value of the investments in which we have made investment. Now, what would be that change in value of our investment? That depends upon the beta of the security. So, in order to compute that, say what will be the revised value of the equity component, we need to have the beta information. As far as the beta is concerned, it is indicating that say what is the percentage change in RJ with percentage change in RM. Means what is the change in the return of the security that is required to be compared taking into account the market changes. This is required to be found. So, percentage change in RJ is equal to beta into percentage change in RM. This is provided as it reduces by 5%. Multiplying with beta. Now what is beta? Over here, say we are required to use this information to compute the beta. Listen carefully. Sharpe ratio is given to. We know, dear students, that say the Sharpe ratio is calculated. The recent formula that say we have seen, x per minus RF divided by standard deviation. What is Sharpe ratio? It is 2. What is standard deviation? 11.25. So can we say that say this is 2, this is x per minus RF divided by 11.25. So x per minus RF is equal to 2 into 11.25. So x per minus RF is equal to 22.50. So we got 22.50 value. Yet we have not got beta. Don't worry. Gradually we'll do everything. Trainer's ratio is 15. Now as far as the trainer's ratio is concerned, its formula is similar to this. X per minus RF divided by what? Beta of the security which we require. So now beta is equal to x per minus RF divided by trainer's ratio. Now what is x per minus RF? It is 22.5 divided by what? Trainer's ratio. What is trainer's ratio? It is 15. So 22.5 divided by 15. That comes to 1.50. Fine. Now we got the beta 1.5. Listen carefully, that say what we are required to do further. Once you have beta, it is 1.5. You can understand that say the 1.5 into negative 5%. So it comes to negative 7.5%. What will happen? Say whatever the value of your investment, that will reduce by 7.5%. So 70 minus 7.5%. That is the way the revised value of the equity will be calculated. Then information is provided to us that there is an annual average cost of 3 rupees per unit for the scheme. And we are required to make the computation of the answer for 1 month only. So 3 rupees is for the entire year. So for 1 month it will be how much? That we will compute. So minus 3 upon 12. So 71 paise minus 3 upon 12. It comes to 25 paise. It comes to 46 paise. That's it. This is the way we make the computation of the equity value, cash and bank, and finally we will have the net asset value of the mutual fund. So what is the sequence in which we do answer? Sequence in which we do answer is, we'll make this calculation first of all, that is X per minus RF. This we will do. We'll do it properly, friends. Then by using this Trainer's ratio formula, we'll make the calculation of the beta. Afterwards, we'll apply the formula for the percentage change in RJ in order to compute what will be the percentage change in return. That is the third thing that we will do. Fourth is this, fifth is this, and that is the way the final answer will be calculated. Of course, whatever we are doing for the one mutual fund, the same itself is required to be done for the other one. In my opinion, understanding the sequence in which you are required to do answer is very important. Not only the calculation is important, however, the sequence in which you have to do answer is also important. So I think that it is answer of question number 5. Answer of question number 5. In that, working note number 1, calculation of equity and cash balance at the beginning of month. There are two mutual fund schemes. For them we are required to do answer. Mutual fund, it is D and K. We'll write the equity, we'll write the cash and bank, and that is the way we'll write the total. For D mutual fund, NAV is given as 70.71 and for K it is provided as 62.5. So it is 70.71 and this is 62.5. 70.71 into 99%. That comes to 70 rupees. And the remaining balancing figure 71 paise. For the next one, 96% is equity. So what will happen? It is 62.5 into 96%. That comes to 60. So the remaining this amount is cash and bank. 2 rupee 50 paise. So this is the way, first of all, we do the initial bifurcation. जो भी हमको, that is the whatever the NAV information given to us, that's initial bifurcation is done. That is the first working note. Working note number 2, calculation of X per minus RF. This is what we are going to do. Sharp ratio is equal to X per minus RF divided by standard deviation. So X per minus RF is equal to Sharp ratio into standard deviation. Again we will make the calculation for two mutual funds D and K. it is for D and it is for K. For D mutual fund, it is Sharpe ratio is 2 and standard deviation is 11.25. So 2 into 11.25. For the next one, Sharpe ratio is 3 and standard deviation is 5. 3.3. So this is 3.3 into 5. So what will happen? 2 into 11.25, that comes to 22.5. 3.3 into 5, it comes to 16.5. Next, working note number 3. Calculation of beta. Trainer's ratio is X per minus RF divided by beta. So beta is X per minus RF divided by Trainer's ratio. Again, there are two mutual funds. It is D and K. D mutual fund and K mutual fund. X per minus RF is 22.5 and over there it is 16.5 divided by Trainer's ratio is 15 for both of them coincidentally, same, it is 15 and 15. So beta is 22.5 divided by 15, 1.5. 16.5 upon 15, it is 1.1. Okay, that is the way we will make the computation of the beta. Next, working note number 4. Calculation of percentage change in equity value. For that, say we understand like this: beta is indicating percentage change in RJ divided by percentage change in RM. So percentage change in RJ, that is return of the security, is equal to beta into percentage change in RM. Now what is beta? That we have. What is percentage change in RM? That is negative 5%. It is to be computed for mutual fund D and mutual fund K. Beta is provided 1.5 and for the other one it is 1.1. Multiplying with the percentage change in RM is negative 5%. This is negative 5%. So what will happen? 1.5 into 5, 7.5% negative. 1.1 into 5, that is negative 5.5. Okay. Afterwards, the final answer, wherein we will make the computation of the NAV per unit of both the mutual funds. Calculation of NAV per unit for each mutual fund after 1 month. D and K. So it is D mutual fund and then it is K mutual fund. Okay. In that, say first of all we will write the equity and then we will write the cash and bank. As far as the D mutual fund is concerned, friends, we can see that the equity value is 7070 rupees and there is a reduction of 7.5 percentage. 70 minus 7.5 percentage. The cash balance is 71 paise minus 3 upon 12. For K mutual fund, it is 60 rupees minus 5.5 percentage. Because for K mutual fund, so the amount of equity investment is 60 rupees here and it reduces by 5.5 percentage. Cash and bank is 2 rupee 50 paise. So what will happen? It is 2 rupee 50 paise minus 3 upon 12. This is the way we will make the computation of the NAV per unit for D mutual fund and K mutual fund. So over here 70 rupees minus 7.5%, that comes to 64.75. So this is 64.75. Then 3 divided by 12, that comes to 25 paise. It is subtracted from 71 paise. It comes to 46 paise. So the final answer comes to 64.75 plus 0.46. It comes to 65.21. That is the final answer. This is NAV per unit after a month. 60 minus 5.5. It is 56.7. 3 divided by 12 is 25 paise. It is subtracted from 2 rupee 50 paise. It comes to 2 rupee 25 paise. Plus 56.7. It comes to 58.95. That is the way we can make the computation of the NAV per unit at the end of 1 month. Next question. Question number 6. Mr. SG Gold 5-month 4 Nifty Question number 6. Mr. SG sold 5 4-month Nifty futures on 1st of February 2020 for rupees 9 lakhs. At the time of the closing of trading on the last Thursday of May 20 expiry, index turned out to be 2100. The contract multiplier is 75. Based on the above information, calculate. First question. The price of one futures contract on 1st of February 2020. So friends, over here the transaction is provided to us like this. Let's say there is a trader called Mr. SG. This trader has entered into a transaction. What? For sale index, for sale Nifty. How many? 5. The time period is 4 months. We understand it is February, March, April and May. Of course, it is the 1st of February on which the transaction is entered upon, and it is for the month of May 2020 for an amount of rupees 9 lakhs. So whatever the contract in which that is he has entered upon for sale has a value of 9 lakhs. How many contracts are entered upon? 5. Use your calculator. 9 lakhs upon 5. What must be the value of one futures contract? 1,80,000, and that is our answer of very first question. The first question says that say compute the price of one futures contract on this date. So what is the price at which we must have entered into the transaction for sale index? That is the question. So we can give answer of the first question like this. It is answer of question number 6. Answer of question number 6. We understand that say value of futures contract is equal to total sale value divided by number of contracts. Total sales value is in amount of 9 lakhs and number of contracts which have been entered upon are 5. 4 months is the time period and the number of contracts are 5. So we understand it is an amount of rupees 1,80,000. That is answer of our very first question. Second question. Approximate Nifty Sensex on 1st of February 2020 if the price of the futures contract on the same date was theoretically correct. On the same day, RF and the dividend yield on the index was 9% and 6% per annum respectively. Friends, over here language of the question is very well provided to us. Even if such information is not given, we have to make that assumption. Now what is the second question? I explained the second question to you. The second question says that say you are required to make the computation of a kind of spot index value. The second question is that on 1st of February 2020, what must be the spot index value that you are required to compute? If at all, for the month of May 2020, the futures index value is, we understand at say 1,80,000 is the total value of all 5 futures contract. So we understand at say 1,80,000 is the value of one futures contract. We have been provided with the information that say the lot size is 75. 180 is the value of one futures contract, So 1,80,000 divided by 75. Yes. So the futures index value must be 2,400. The question says that what must be the spot index value? There is a very good clarity made in the question that this futures value is the correct futures value. It means that say that theoretically whatever the futures price should be, the same is 2,400. Then in that case, what must be the spot index value? That is the question. Let us have understanding that say how to make the calculation of answer. We understand that say in order to calculate the answer of the second question, working note number 1, calculation of futures index value. Dear students, when I speak that say the futures index value, means what I want to tell you is that the futures index value prevailing on 1st of February for the month of May. Okay? Futures index value. It is futures index value into lot size is equal to futures value of one contract. What is futures index value that we are required to find? Lot size is 75. Futures value of one contract is 1,80,000. So it is 1,80,000 upon 75. That comes to 2,400. Now once you have the futures index value, then you will compute the spot index value. So calculation of spot index value. How we will make the computation of the same? Futures index value is equal to spot index value plus interest minus dividend. This is 2,400. This is x. X plus x into the rate of interest is provided to us as 9% and dividend yield is provided as 6%. 0.09 into 4 divided by 12. So the interest is added minus x into 0.06 into 4 divided by 12. Dividend is deducted. Because we understand that to the extent of the payment of the dividend, value of the stock is falling down, and to the extent of the interest, so the value of the stock is going up. That is the basics that we have. So over here 2,400 is equal to, what you can do, it is x plus x into 0.09 minus 0.06 into 4 divided by 12. Why? Because we understand that, say, except this 2, all other things are same. So 2,400 is equal to x plus x into 0.03 into 1 by 3. So 2,400 is equal to 1.01x. That is the way we will have the x value to be computed. It is 2,400 divided by 1.01. So it is 2376.24. That is the way we can have, so the futures index value, sorry, spot index value, or we can write it as 2376. That is the spot index value. Next, the maximum contago / backwardation. That is a question. The next question is calculation of the maximum contango / backwardation. Let us see that, say, how to make the calculation of answer. This answer of the third question. In order to compute the contango or backwardation, first of all, working note number 1, calculation of basis. How it is calculated? Basis is calculated as spot minus forward. What is spot? Spot is 2376. And what is forward? Forward is 2400. In that case, it comes to 24. And if at all the answer comes to negative, then in that case it is considered to be the contango. So over here, contango is 24. Simple over here, the concept is that if at all the forward is more than spot, then in that case, so it is considered to be contango. If at all the forward is less than spot, then in that case it is considered to be the backwardation. This is the simple concept that we have. I explain the same by way of a small diagram to you. On x-axis I am taking independent factor, that is the spot price, and on y-axis I am taking the dependent factor, that is a forward price. What happens at, say, as and when the time is passing by, always say the forward price will reach to the near to the spot price. This is considered to be the contango. If at all the forward price is less than the spot price, then in that case it is considered to be the backwardation, However, again, in that case, say the price will reach to the spot price by the time the option will expire, that is by the time, so the futures contract will expire. That is what, say, we understand that, say, over here, contango is 24. In simple language, we understand that basically the cost of carry model, in that, say, the spot plus the additional element is contango. And sometimes it may happen that, say, the dividend amount is more than the rate of interest. Then in that case, the forward would be less than spot, and that difference is considered to be backwardation. Next, what is the payoff of the transaction? That is very simple. The question says that, say, at the time of closing trading on the last Thursday of May 20, last Thursday of the May 20, index turned out to be 2100. So answer of the fourth question, in that we understand, is calculation of profit or loss. It will be calculated as sale value minus purchase value. What is the price at which you already have sold? It is 9 lakhs. Now, what is the price at which you are going to buy? It is 2100. What is the lot size? It is 75. And what is the number of contracts? Number of contracts are 5. So it is 9 lakhs minus 2100 into 75. It comes to 1,57,500 into 5. So 9 lakhs minus 157,500 into 5, 7,87,500. So ultimately there is a profit of 1,12,500. So this transaction has resulted into profit of 1,12,500. So let us have a summary of this question. It has been provided to us that the trader has entered into the transaction for sale 5 contracts. The time period is 4 months. The total value is given as 9 lakhs. So 9 lakhs divided by 5. So for one contract it is 1,80,000. Multiplied is given 75. So we got the value of the price at which the contract has been sold as 1,80,000 divided by 75. The first question is, what is the price of one futures contract? 1,80,000. The question says that, say, what must be the spot index value? We understand that, say, from the futures price we are required to go backward, and based on that, say, the spot price will be calculated. This is like the difference between the spot and forward. That is what 24, and the payoff means a kind of profit that, say, you will be able to find. Carry out the calculation on month basis. This is what we have done. Question number 7. A rice trader has planned to sell 22,000 kg of the rice after 3 months from now. So information is given that, say, after 3 months a rice trader is going to sell 22,000 kg of rice. The spot price of the rice is 60 rupees per kg, and 3 months futures on the same is trading at the rate of 59 rupees per kg. In spot, value is 60. In futures, it is 59. The size of the contract is 1000 kg. So 1000 kg, or in multiple of that only you can sell or buy. Coincidentally, we have 22,000 kg. So 22,000 kg divided by 1000 kg, that gives us the number of contracts in which we will enter upon in case of the futures contract is 22. the price is expected to fall as low as 56 rupees per kg 3 months hence. It means that the information is given that we are expecting, we are forecasting that the price will be only 56. We understand that say, of course, we have a threat that say the price will fall down and we will be having a loss. Why? Because we are having a planning to sell. It means that say right now we must be holding it and after 3 months we want to sell it, and we are having a fear that the price will fall down. You are required to interpret the position of the trader in the cash market. Of course, in the cash market you must be holding the rice. It means that say you have the long position in the cash market. So answer of question number 7 in that first point, that is first answer. It has been given that trader has planned to sell rice after 3 months, comma, it means right now trader must be having rice, full stop. Trader is having long position in cash market / spot market. That is answer of the first question. Next, you are required to advise the trader. The trader should take in futures market to mitigate its risk of the reduced profit. In simple language, you are required to advise the trader that the trade, that is the transaction in which he should enter upon in order to mitigate the risk. Dear students, answer is very simple. You are expecting the price to fall down. So in that case, today you should enter into the transaction for sale. So over here, answer for the second part of the question. As trader is expecting price to fall down, so today trader should enter into futures contract to sell rice. Simple. Nothing great to learn or to understand. Demonstrate effective realized price for its sale if he decided to make use of the futures contract. What does it mean? It means that the trader has entered into the transaction for sale of rice, and after 3 months spot price is 57 and the futures contract closing contract is at the rate of rupees 58 per kg. Okay. So now over here the question says that what is the effective realized price for the sale? Listen carefully. Third, we understand like this. Write down answer along with me if at all you are writing answer. Today, trader should enter into futures contract to sell rice. After 3 months, trader will square off futures contract and, listen carefully, and will sell rice in spot market. So after 3 months, whatever the futures contract in which you already have entered upon will be squared off, and whatever the rice that you have, so that you will sell in the spot market. Hence we understand like this: sale value of rice in spot market. Dear students, it is provided that we are going to receive an amount of rupees 57 per kg. So 57 rupees per kg multiplying with 22,000, that is the actual commodity that you have. So you get 12,54,000. Afterwards you will consider profit or loss due to futures contract. In that you are required to consider the difference of sale value minus purchase value. See, as 22,000 kg divided by 1000, that comes to 22 contracts. Number of contracts do not have any significance over here. Otherwise the number of contracts would be important. Suppose we are having 21,800 kg with us. Then in that case 21,800 divided by 1000, it comes to 21.8. So you can enter into the futures contract 21 or 22. Suppose you are having 21,200 kg of the rice with you, then in that case 21,200 divided by 1000, so it is 21.2. So 21 or 22 contracts. Friends, over here you will mention the actual number of actual quantity that you will sell. Whatever the in spot you are having, the quantity of the rice that you will sell over here in the spot market. And when you are doing the square off, in that case you are required to take into account the number of contracts in which you have entered upon. Okay. The question is providing the information that the futures price is 59. So what will happen over here? It is 59 multiplying with 22,000 minus. Information is given that over here spot price is 57 and the futures price is 58. So the contract is squared off at the rate of 58 rupees per kg. Okay, so 59 minus 58 into 22,000, so there is a profit of 22,000. So 12,54,000 plus 22,000. So the amount realized is in total 12,76,000. So this is the total amount realized. Okay. The next is price per kg. What will happen? It is 12,76,000 divided by 22,000. So the price per kg is 58. So 58 rupees is realized on per kg. This is what we understand. I summarize the explanation. See, after 3 months, what will happen? Whatever the rice that you have with you, that you will sell in the spot market. So what you realize is 12,54,000 on sale of 22,000 kg in the spot market. Now the futures contract in which you have entered upon is to sell at the rate of 59. Now this contract is required to be squared off by entering into the reverse of the original futures contract, and at that point of time the rate is 58. So difference of that is what you are able to realize is 22,000. So the total amount is 12,76,000 divided by 22,000 kg. So per kg you realize 58 rupees. Now suppose, just I am explaining to you, suppose the question is providing that say you are having 21,800 kg for example. Then what will happen, friends? 57 rupees that you realize per kg into 21,800. So you get 12,42,600 on sale of the rice that you have. 21,800 divided by 1000, that is the lot size, 21.8. However, you cannot enter into fraction number of contracts. So suppose you have entered into 22 number of contracts because 22 is near to 21.8. If somebody is taking 21 is also acceptable. Be clear with that. So what will happen? So the profit in the futures contract will be 22,000 only. So what will happen? 12,42,600 plus 22,000. So the amount is 12,64,600. And 21,800 kg. For this quantity, amount that you realize is 12,64,600. So the price per kg would be 58.0091 or 92. This is the way you are required to calculate the answer. Fine. Now again, friends, this is a question very similar to question asked in May 2019 examination, question number 5A, 8 marks. This is for SFM new. Okay. Question number 8, next question. Citibank quotes exchange rate of 105/106.5 Japanese yen per dollar, and Hong Kong Bank quotes the exchange rate of 0.0090/0.0093 dollar per yen. The first question is, are these quotes identical? If not, then how they are different? That is a question. So over here, the first thing that we are required to answer is whether these quotes are identical or they are different. We can say something like this. Answer of question number 8. We have been provided with the quotations of two banks. One is Citibank in that 105/106.5. (105/106.5). It is yen per dollar, and another is Hong Kong Bank for that the rate is 0.0090/0.0093. It is dollar per yen. Like that information is given. Now dear students, we understand that over here the question is basically not specifying that you are required to view the quotes from a US point of view or from the Japanese company point of view, from which point of view you are required to view it. So you can give answer by either of the method. So if at all we see from the US citizen or from the US company point of view, then from US company point of view we can say like this. If at all we see from the Japanese company point of view, then in that case the Citibank quote is direct quote and the Hong Kong Bank quote is indirect quote. If at all we see from the US company point of view, then in that case the Hong Kong Bank quote is the direct quote and this is indirect quote. So to that extent there is a difference. So here we can say that from the US company point of view, Citibank quote is indirect quote and Hong Kong Bank quote is in direct quote. That is the only difference that we have, friends. Next, second question. Is there any possibility of arbitrage? That is a question. Let us see that first of all we'll identify that whether an arbitrage opportunity is existing or not, and if it is existing, we'll make the computation of the arbitrage. So Citibank, in that the exchange rate is given as 105/106.5 yen per dollar. As far as the Hong Kong Bank is concerned, for Hong Kong Bank we are required to take the reciprocal rate. How reciprocal rate will be taken? It is 1 divided by 0.0093 slash 1 divided by 0.0090. It is dollar per yen. Dear students, when we are making the reciprocal, at that time we have to be careful that the left hand side rate is lower than the right hand side rate. So what will happen? 1 divided by 0.0093. So it comes to 107.52 or 53 we can take slash 1 divided by 0.009, that comes to 111.11. That is the way, so we are required to make the comparison. So this is the dollar per yen and we have computed the reciprocal rate, which is yen per dollar. Now making comparison of this two, we understand like this. Listen carefully what I am going to speak. What you can do, you can say purchase the dollar currency at the lower rate, that is at 106.5, and you can sell at a higher rate, that is 107.53. If at all you purchase dollar, then from Citibank you can purchase the dollar at 106.5, and the same dollar can be sold in Hong Kong Bank for 107.53, and difference of that is the profit that you will be able to make. So we understand like this. Conclusion. We can write the conclusion like this. Purchasing rate of dollar from Citibank is less than selling rate of dollar in Hong Kong Bank so arbitrage exists. This is what we understand. Understand friends, that's a purchasing of the dollar from Hong Kong Bank and selling in the Citibank will have a loss, because you will buy dollar at the rate of 111.11 and you will sell it 105. Then in that case, difference of that would be your loss. Over here the question says that is there any possibility of arbitrage or not? That is the only question for which you are required to answer. Next, if there is an arbitrage opportunity, yes, arbitrage is there, then show how would you make profit from the given quotations in both the cases. If you are having 1 lakh Japanese yen and if at all you have 1000 US dollar. So in two situations you are required to make the computation of arbitrage. If you have 1 lakh Japanese yen and if you have 1000 US dollar. Okay. So we understand that answer of the third question, calculation of arbitrage. Dear students, in both the cases, you have to understand that the transaction is going to be same. That is purchase United States dollar from Citibank. So we understand that in Citibank, you have to do the transaction for sell of yen and purchase of dollar. And in Hong Kong Bank, you are required to convert the dollar into yen. So in Hong Kong Bank, it is sell of dollar and purchase of yen. This is what you are required to do in both the cases. Okay. First of all, let us do the answer in the sequence in which already have written it. That is sell of yen currency first. We have been provided in one of the two questions that you have 1 lakh Japanese yen. So what you will do, listen carefully. Bank, then we understand is the transaction, then we understand is the exchange rate, then amount. Since Citibank, you will enter into the transaction for sell of yen and purchase of United States dollar. In Citibank, what is the exchange rate provided to us? The exchange rate is this 105/106.5. 105/106.5 yen per dollar. Now listen carefully, the transaction is sell of yen and purchase of dollar. It means that the higher amount of yen is required to be given to buy a dollar. So what will happen? It is sell of yen and purchase of dollar. For 106.5 yen, you will get $1. You have 1 lakh yen which is given to us in the question. 1 lakh divided by 106.5. So 938.97. 938.97 United States dollar. You'll get this. Okay, then you'll go to the Hong Kong Bank. In that it is sell of dollars and purchase of yen. Okay, what is the exchange rate applicable? 0.0090 slash 0.0093. 0.0090 slash 0.0093 dollar per yen. Okay, now understand carefully. What will happen? You have United States dollar. Now you will convert dollar into yen. What does that is? In that case, what happens that it is 0.0093 dollar per yen. The transaction is sell of dollars and purchase of yen. You are required to sell higher amount of dollar to get a yen. So what happens at say on 0.0093 dollar, you will get 1 yen. Okay. So now what will happen? You have an amount of 938.97 dollar. So you will get this amount of yen. So it is 938.97 into 1, that does not make a sense, divided by 0.0093. 938.97 divided by 0.0093. It comes to 1,964.52. So it is 1,964.52 yen. This is the amount of yen that you will get. Let us have a summary of this. First of all, as a student, you need to have the understanding of the logic that say in which transaction you will enter upon. Whether you have been given yen currency or you have been given dollar currency. First of all, you should be clear the sequence in which you are required to enter into for the purpose of arbitrage. We have made comparison of both the exchange rates. The comparison is made in the common currency, that is the yen per dollar rate. This is compared with this. Okay. Then we have found that say the purchasing rate of the dollar and selling rate of the dollar. In that say there is a difference and the purchasing rate is essentially lower. That is required. The purchasing rate is lower than the selling rate over here. Suppose this exchange rate is greater than 107.53 friends, then in that case arbitrage is not possible. Okay, over here we understand that say the purchasing rate of the dollar is lower in comparison to the selling rate of the dollar. You can buy dollar from Citibank at the lower rate and you sell in Hong Kong Bank at a higher rate. That is the way first of all you have returned simply the transaction. Okay. Now what happens at say the exchange rate is given to us. It is 105/106.5 yen per dollar. Which transaction do you enter upon? Sell of yen and purchase of dollar. To buy $1, you are required to sell higher amount of yen. That is the reason say this exchange rate is taken. For every 106.5 yen, you will get $1. You have 1 lakh Japanese yen as it is given to us in the question. 1 lakh. So you will get this amount of dollar, that is 938.97. Okay. Now you will complete the transaction. In Hong Kong Bank, you will convert dollar into yen. So what happens at say for higher amount of the dollar, you will get a yen, that is 1 yen. You have to sell 0.0093 dollar. You have to give more amount of dollar to get a yen. You have 938.97 dollar. So you will get 1,964.52 yen. So finally, arbitrage amount is 1,964.52. 964.52 yen minus 1 lakh yen with which you had started. So the difference is 964.52 yen. That is the amount of arbitrage. Proceeding further, second part of the question. In second part of the question says that suppose you have 1000 US dollar. You have an amount of 1000 US dollar. Then what you will do? As I told you that the transactions are going to remain same. In which what you will do? You will convert yen into dollar and then dollar into yen. You will convert yen into dollar and then dollar into yen. However, unfortunately, we have dollar with us first. Okay, so you will do this transaction first and then you are required to do this transaction second. Simple. There is nothing great to be done. So what will happen? First of all, you will start the calculation of arbitrage with $1,000. Logically, whatever we have written, that I am writing first of all. Citibank, this is what we have written logically. Sell of yen and purchase of dollar. And then Hong Kong Bank, it is sell of dollar and purchase of yen. Like that, say there are two transactions. This time you have dollar currency with you. So dear students, this will become your transaction number 1 and then this will become your transaction number 2. That is the way you are required to do the answer. So what will happen in Hong Kong Bank? It is sell of dollars and purchase of yen. Okay. How much amount of dollar you have? You have $1,000. Okay. What is the exchange rate? In Hong Kong Bank, the exchange rate is 0.0090/0.0093. So the exchange rate is 0.0090/0.0093 dollar per yen. Sell of dollars and purchase of yen. So this is the rate applicable. So what will happen? It is 1000 divided by 0.0093. 1000 divided by 0.0093. It comes to 1,07,526.88. 1,07,526.88. This is the amount of the yen that you will get. Okay. Then you will come to the Citibank. In that case, it is sell of yen and purchase of United States dollar. You have 1,07,526.88 yen and you will get your dollar. Okay. Exchange rate is this 105/106.5. 105/106.50 yen per dollar. See, the transaction is sell of yen and purchase of dollar. Again, you are required to sell higher amount of yen to get a dollar. So 106.5 is the relevant rate. So what will happen? 1,07,526.88 divided by 106.50. Okay. So 107,526.88 divided by 106.5. So it comes to 1,009.64 dollar. 1,009.64 is exceeding 1,000. So again you have an arbitrage. $1,009.64 minus 1,000. That comes to $9.64. This is the way in both the cases you can compute the amount of arbitrage. I would say that this is one of the good question that they have kept. Question number 9A, next question. Given 107.31 yen per dollar, $1.26 per UK pound, 0.70 United States dollar per Australian dollar. Calculate the cross currency for pound in yen terms. What does it mean? It means that what is the exchange rate of yen per pound? That is what we are required to calculate. So answer of question number 9A. First of all, writing the exchange rates, 107.31 yen per dollar. $107.31 yen per dollar. Then $1.26 per UK pound. Then I think $0.70 per Australian dollar. Okay. The first question is calculate the cross currency rate for pound in yen term. Means the price of pound in terms of yen. We are required to calculate yen per pound. Okay. Looking to the information provided, we can observe that against yen dollar currency is given and against pound again dollar currency is given. So we can take the dollar currency common to compute yen per pound. The question says that what is the amount of yen per UK pound? That is a question. So the final answer that we will have will be in yen term. Answer is required per pound. Against pound a dollar currency is given. I want answer in yen currency, not in dollar currency. So in order to calculate, that is cancel the dollar from the numerator, it will be kept in denominator. And against dollar yen currency is given. And I want answer in yen currency term only. This is the way the equation is formed. I repeat the explanation of the equation once again, if at all anybody wants to understand. The equation will be formed like this. We require the answer in yen currency term per UK pound. I want answer in yen currency, not in pound. So to cancel the pound from the numerator, it will be kept in division. Against pound a dollar currency is given. So I am mentioning over here dollar currency. I want answer in yen currency, not in dollar currency. So again to cancel the dollar from numerator, it is kept in denominator. And against dollar yen currency is given. I want yen per dollar and the same is provided to us in the question. 107.31. I want dollar per pound and the same is given 1.26. Answer is required per pound. Okay, the answer is required per pound. So the final answer is 107.31 into 1.26. So it is 135.21. Yen per UK pound. Next, the question says that calculate the cross rate for Australian dollar in yen term. Okay, so now again we are required to compute the cross currency rate. This time it is required to be computed for Australian dollar again in yen term. So we are required to find yen per Australian dollar. So the answer for the second part of the question, yen per Australian dollar. Now we can see again that against yen dollar currency is given. and against Australian dollar also the dollar currency is given. So again you will take the dollar currency as common to make the calculation of answer. I want answer that say what is the amount of yen per Australian dollar, that is a question. So the final answer is in yen term against Australian dollar. Against Australian dollar US dollar is given, and against US dollar yen currency is given. I want yen per dollar, the same is given 107.31. I want dollar per Australian dollar, the same is given, so into 0.7 into 1. So 107.31 into 0.7, so it comes to 75.12. It is yen per Australian dollar. Next, calculate the cross currency rate for pound in Australian dollar terms. So the question says that you are required to find the cross currency rate for the UK pound in Australian dollar currency term. So over here, third part of the question, cross currency rate for UK pound in terms of Australian dollar. So it is Australian dollar per UK pound. Again, against Australian dollar, dollar is given, and against pound also dollar currency is given. Fine. So we understand that the dollar currency will be taken as common. 1 pound is equal to how many Australian dollar? That is the question. Final answer is in Australian dollar currency term per pound. Against pound dollar is given, and against dollar Australian dollar is given. I want Australian dollar per US, that is US dollar. However, you can see that the reverse is given. See, that's the formula demands Australian dollar per United States dollar, Australian dollar per dollar. However, I have dollar per Australian dollar. So what I have to do, friends, I have to make the exchange rate reciprocal. How to make reciprocal? Very simple. In case of a single currency, 1 divided by 0.70. In case of the buying and selling rate, in making the cross currency rate, you had to be careful, as what we did in the previous question. Suppose the exchange rates are 2/4 dollar per pound, and you are required to make the cross currency. Then it is 1/4/1/2 pound per dollar. Why? Because we understand that the left hand side rate has to be lower than the right hand side rate. The purchasing rate of the dollar currency must be greater than the selling rate of the dollar currency. That is the simple logic that we have. However, over here there is only a single currency, so there is no issue. Okay, I want dollar per pound, and the question is providing the dollar per pound, so we'll keep it as it is. It is 1.26 into 1. So 1.26 divided by 0.7, it comes to 1.8. So it is 1.8 Australian dollar per UK pound. That is the way we'll calculate the answer. B part of the question. The current spot exchange rate is $1.35 per pound, and 3 months forward exchange rate is $1.30 per pound. Spot is given and forward is given. According to your analysis of exchange rate, you are quite confident that spot exchange rate will be $1.32 per pound after 3 months. So you are expecting that after 3 months the exchange rate will be $1.32 per pound. Suppose you want to be you want to speculate in the forward market, then what course of action would be required and what is the amount of the expected dollar profit or loss from this speculation? That is the question. So over here the question says about the speculation. We know that say the forward is the rate at which you can do a committed transaction, and the question is providing the information over here. You are expecting that the exchange rate will be $1.32 per pound. So answer of question number 9b. Information is provided that so the today spot exchange rate is $1.35 per pound. Spot is $1.35 per pound. Forward is $1.30 and expected spot is $1.32. Forward is $1.30 per pound and expected spot is $1.32 per pound. It means you are expecting that say the pound currency will have more value than the forward quotation that we have. So simply what you will do, for the purpose of, listen carefully, for the purpose of speculation, comma, in forward contract, pound will be purchased at the rate of $1.30 per pound, full stop. After 3 months, comma, it will be sold in spot market at the rate of $1.32 per pound. That's it. What you are required to do? Say today you will enter into the forward contract in which you will purchase, that is UK pound, at the rate of $1.30. After 3 months, you are expecting that so the exchange rate will be greater than 1.30. So what you will do, set spot rate 1.32, you will dispose of your investment at 1.32 and difference of that will be your gain. The question says that, say suppose you want to speculate in the forward market, then what course of action would be required? See, here is the point at which our answer ends, that is whatever we have written so far. The question further says, what is the amount of the expected dollar profit from this speculation? That is the question. Then third question is also given. What would be your profit or loss in dollar terms on the position taken as per your speculation if the spot exchange rate turns out to be 1.26? Assume you would like to buy or sell 10 lakh UK pound. Means in the first part of the question, listen carefully, in the first part of the question, you are required to give answer that say if at all the transaction is entered upon for 1 million UK pound, then in that case, what is your expected gain if at all your expectation materializes? It means that so the actual exchange rate is what same as what you anticipated. Then in that case, what is the amount of the profit or loss? That is, what is the amount of the profit that you will have, that you are required to calculate. So continuing with the first part of the question. If transaction is if transaction is entered upon for 10 lakhs UK pound, comma, amount of profit will be as under. Listen carefully what I am going to speak now. In forward you will purchase pound at the rate of 1.30. Yes or no? Yes. So 1.30 is the rate at which you purchase, say, UK pound. In spot you will sell at 1.32. Yes or no? Yes. So difference of that you will make a gain per UK pound 0.02. Yes. What is the amount for which the transaction is entered upon? 10 lakhs. So we understand that, say, 1.32 less 1.30, that comes to 0.02, multiplying with 10 lakhs, that is 1 million. So you are expecting a profit of $20,000. That is answer of our first question. Now the second part of the question. What would be your profit or loss in dollar terms if the position is taken as per your speculation and spot rate turns out to be 1.26? Okay. Now in second part of the question, calculation of actual profit or loss. This is what we understand is the calculation of this is the expected profit or loss. Assuming that the things will be as what I anticipate. However, now what happens at the actual exchange rate is 1.26 instead of 1.32. You already have a forward contract in which you have to purchase pound at the rate of 1.3. The pound that you purchase at 1.3 will be sold at 1.26. So do you have a profit or loss? Unfortunately, loss. How much? $0.04 per UK pound. And the transaction is entered upon for how much pound? 10 lakhs. Okay. So 0.04 into 10 lakhs. So unfortunately, instead of profit, there is a loss. How much loss? 40,000 United States dollar. Always the speculation will result into either profit or loss. If the things are as per your expectation, you will gain. If the things are not as per your expectation and it is adverse, then in that case you are going to incur a loss. This is what we understand. Question number 10. Suppose you are a treasurer of XYZ PLC in United Kingdom. XYZ have two overseas subsidiaries. One is based in Amsterdam and another in Switzerland. The surplus position of the funds in the hand is as follows, which it does not need for the next 3 months, but it will be needed at the end of the period, that is 91 days. So for a time period of the initial 3 months, it is not required. Then it will be required. So as far as the UK company is concerned, it has surplus of pound 1,50,000. Swiss subsidiary has Swiss franc 19,96,154 and Dutch subsidiary has euro 14,50,000. Exchange rate as follows are exchange rate as on the date are as follows. The exchange rate is provided in terms of the spot. Then for 91 days we have been provided with the forward points, swap points. We understand that the spot exchange rate is provided as pound per euro. Again, the spot exchange rate is given Swiss franc per pound, and again we have been provided with the forward points, swap points. 91 days interest rates are on per annum basis. on the deposits in the money market are as follows. So the rate of interest is per annum. If you make investment in pound currency, if you make investment in euro currency, if you make investment in Swiss franc currency, for this amount, that is 0 to 2 lakhs, rate of interest is 1%. Exceeding 2 lakhs up to 10 lakhs, it is 2%. Exceeding 10 lakhs up to 20 lakhs, it is 4%. Exceeding 20 lakhs, it is 5.38%. Similarly, we have been provided for euro currency and Swiss franc currency. You have been approached by your banker, wherein above mentioned surplus was lying, requesting you to swap means interchange, the surplus lying with other two subsidiaries and place them in deposits with them. Determine minimum interest rate per annum up to 3 decimal points. This is important. That should be offered by the bank to your organization so that your organization is ready to undertake such swap arrangement. Consider that there are 360 days in a year. Now what is the question? Before I give you the entire explanation of the question, let us have first of all understanding that what sort of information is given to us. The information is given to us like this. Answer of question number 10. Listen carefully. See, basically, as a holding company in pound currency, you have surplus. Your two subsidiaries in Swiss franc currency, they have surplus, and in euro currency also they have a surplus. The first option is that the respective currencies invested over there. So we'll get the maturity in pound, maturity in Swiss franc, maturity in euro. Listen carefully what I am going to speak. Now the maturity in the Swiss franc will be converted into pound. Maturity in euro will be converted into pound. So basically in pound currency, you will have say an amount at the end of the 91 days or 3 months. That is what the first option that you have. Wherein what happens at say you have selected that the respective currency will be invested over there only. So over here you will have the maturity in Swiss franc, maturity in euro, then it is converted into pound, so you get say an amount of pound. This is what the first alternative. Suppose for example this comes to 5 lakh UK pound. Now instead of this, what you may do, you may convert this amount into pound today and this amount of the pound today. So today you get, for example, an amount of 4,60,000 pound. Whatever amount of pound that say you get today is invested in pound currency for 3 months. The question says that what is the minimum rate of interest that say you should bargain so that at least you will get 5 lakhs pound. That's it. I repeat it again. What happens at say, first of all we are required to make the computation of 5 lakh pound. How it is calculated? First of all you compute the maturity amount of deposit in pound currency. Second, you make the computation of the maturity amount of deposit in Swiss franc currency. Then you compute the forward exchange rate between Swiss franc and UK pound and you convert this into pound currency. Maturity amount of deposit in euro currency, conversion of euro into pound. The total of all of them is 5 lakhs. 5 lakhs I have taken an hypothetical amount. So this is the way you will make first of all the calculation of 5 lakhs. Now next is you will make the conversion of the Swiss franc into pound. You will make the conversion of the euro into pound. You will get the total amount. That's it. You will make the computation of the difference of these two, and that is the way you will compute the rate of interest in pound currency, so that say at least you will get the maturity of pound 5 lakhs. This is the way we are required to make the calculation of the simple answer. So let us go one by one. Working note number 1, calculation of maturity amount of deposit, in bracket I am writing pound currency. In that case it is principal plus interest. What is the principal amount? Principal amount is 1,50,000. Now importantly you are required to see this table properly. See, this 1,50,000 is falling over here in the first bracket. So the rate of interest is 1%. Be careful for this small point. It is not a conceptual point, yet there is a possibility that you may commit a mistake. So 1,50,000 plus 1,50,000 into 1% into 91 divided by 360. So 1,50,000 plus 1,50,000 into 1%, 1,500 into 91 divided by 360, 379.167. That is the way the maturity can be calculated. So the maturity amount of deposit is 1,50,000 plus 379.167. So 150,379.17. So this is the maturity amount of deposit in pound currency. Okay. Then working note number 2. Calculation of maturity amount in Swiss franc term. Again the principal plus interest, means they are investing independently over there. What is the amount? Amount is 19,96,154. Okay, so the Swiss franc is over here. So it is falling in this, more than 10 lakhs, less than, up to 20 lakhs. So the rate of interest is 0.5%. So it is 19,96,154 plus 19,96,154 into rate of interest is 0.5%, and the time period is 91 days. So 19,96,154 plus into 0.5% into 91 divided by 360. So 2,522.92. 1996,154 plus 2522.92. So it comes to 1998,676.92. This is the amount of the Swiss franc. Working note number 3. In this, what we will do, we'll have the conversion of this Swiss franc into pound currency. Okay. Now we have been provided with the exchange rates. Here is the exchange rate. This is relevant. Spot exchange rate is given as Swiss franc per pound, and then forward points / swap points are provided to us. Spot exchange rate is given 2.3295, 2.3295 / 2.3326, 2.3326 Swiss franc per pound. Then we understand that it's the 3 months forward points. It is 0.0242, 0.0228. Okay, is it high low or low high? It is high low. So add or deduct? Deduct. So 2.3295 minus 0.0242. So 2.3053 / 2.3326 minus 0.0228, 2.3098. Swiss franc per pound. This is 3 months forward exchange rate. Okay. Now we'll have the conversion of Swiss franc into pound. So the forward contract, sell of Swiss franc and purchase of pound. Okay, what is the amount of Swiss franc? 19,98,000. 676.92. So for this amount of the Swiss franc, we'll get this amount of the pound. Okay. It is Swiss franc per pound 2.3053 / 2.3098 Swiss franc per pound. So the conversion of the Swiss franc into pound. So higher amount of the Swiss franc per pound, Swiss franc pound, 2.3098 Swiss franc is equal to 1 pound. Maturity amount of deposit is 19,98,000. 676.92 Swiss franc is equal to this amount of pound. Okay, so 19,98,000, 676.92 into 1 divided by 2.3098, 1998, 676.92 divided by 2.3098. It comes to 8,65,000, 8,65,303.02 UK pound. So you'll get this amount of pound. So this is what we understand is working note number 3. Then working note number 4. In that, calculation of maturity amount of deposit. The last currency is Euro currency. Again in that, principal plus interest. What is the principal amount? Principal amount is 14,50,000. Quite simple value. Plus 14,50,000 into rate of interest. For euro currency, the rate of interest is provided to us as 14,50,000 is falling in this range again. So it is 2%. So it is 0.02 into 91 divided by 360. 14,50,000 plus into 2% into 91 divided by 360. That comes to 7,330.56. $14,57,330.56. This is the amount of euro. Again, we are required to do the conversion of this amount of euro into pound. So, working note number 5, conversion of euro into pound. Okay, we have been provided with the exchange rate. Here is the spot exchange rate, and forward points have also been given to us. 0.6858, 0.6869, 0.6858 slash 0.6869 pound per euro. 6858, 6869. Okay, 91 points are 3740. 0.0037 slash 0.0040. This is spot and this is 3 months forward points. As it is low high, it will be added to spot exchange rate to compute the forward exchange rate. 0.6858 plus 0.0037. So 0.6895 slash 6869 plus 0.0040. So 0.6909. It is pound per euro. Okay. So we understand that, say, the transaction is sell of euro and purchase of pound. So for every 1 euro that you sell, you will get lower amount of pound. So for every 1 euro, you will get 0.6895 pound. So we understand that, say, the pound and euro. 0.6895 pound for every 1 euro. And over here, say, this is the maturity amount of deposit. 14,57,330.56. So this is the amount of pound for 1457 330.56 euro. So 1457 330.56 into 0.6895 divided by 1. Divided by 1 does not make a sense. 0.6895. So it comes to 10,04,829.42. So 10,04,829.42. This is the amount of pound. So now at this point of time, we can compute the total amount in pound currency term. We can say that, say, first of all, our own maturity amount of deposit 150,379.17. 150,379.17. 1,50,379.17 plus the next is conversion of the Swiss franc into pound. Yes, 8,65,303. 8,65,303.02 plus the last 10,04,829.42. So the total is 20,20,511.61. So I was just discussing with you 5 lakhs. It is actually 20,20,511.61. The next working will be conversion of all foreign currency into pound currency. So over here, after preparing this working note number 5, we'll have the conversion of the foreign currency into domestic currency, so that we will come to know that what is the total value that we have in pound currency right now. Listen carefully all of you what I am going to do. See, we have been provided that we have the pound currency. Yes. Then we have been provided that we have the Swiss franc and euro. Yes. Now these two foreign currency will be converted into domestic currency, that is pound. So we'll get an amount in the pound currency right now. That amount that we have in the pound currency is what we have right now, and after 3 months the maturity amount of the deposit should be at least this amount. Only in that case the conversion of the foreign currency into domestic currency will make a sense. Okay. Let us now make further calculation. So we'll have next is calculation of working note number 6. Calculation of conversion of foreign currency into home currency. This is what we are required to do. So we have Swiss franc 19,96,154. $19,96,154 Swiss franc and 14,50,000 euro. This is what I have. Now the spot exchange rate is provided to us, pound per euro, 0.6858, 0.6869. .6858 slash 0.6869 pound per euro. Okay. Now we'll have the conversion of the euro into pound. So spot transaction, it is sell of euro and purchase of pound. So for every 1 euro you will be able to get the lesser amount of the pound. So what will happen, it is pound euro, it is 0.6858 pound for every 1 euro. What is the amount of the euro that we have? it is 14,50,000. So 14,50,000 euro is equal to this amount of pound. So the answer is 14,50,000 into 0.6858. That comes to 9,94,410 UK pound. 9,94,410 UK pound. Okay. Then Swiss franc. What is the exchange rate provided to us? This is the exchange rate. Dear students will understand that the spot exchange rate will be used for the purpose of this conversion. 2.3295 slash 2.3326. 2.3295 slash 2.3326. Okay, Swiss franc per UK pound. Okay, what would be the spot transaction? Spot transaction will be sell of Swiss franc and purchase of pound. That is the way you have the conversion of the Swiss franc into pound. What is the amount of Swiss franc that we have? It is 19,96,154. 19,96,154. So for this amount of the Swiss franc, we will get this amount of pound. See, the transaction is sell of Swiss franc and purchase of pound. It means that we are required to sell higher amount of the Swiss franc to purchase a pound. These are the basic recognition of the exchange rate. Swiss franc pound 2.3326. 2.3326 Swiss franc per pound. So 19,96,154 Swiss franc is equal to this amount of pound. So the answer is going to be 19,96,154 into 1 divided by 2.3326. 19,96,154 divided by 2.3326. So the answer comes to 8,55,763. 8,55,763.52 UK pound. So this is the amount of pound that you will receive on conversion. So now we'll have the total amount of pound. Right now, what is the amount of the pound that we have? It is 1,50,000. So 1,50,000 pound that we have right now, and on conversion we get this amount of pound, 9,94,410. 9,94,410 plus this is an additional amount that we have, 8,55,763.52. So 1,50,000 plus 994,410 plus 8,55,763.52. So it comes to 20,01,000, 20 lakhs 173.52. This is what we understand is the amount that we get right now on conversion of the foreign currency into domestic currency, and the amount that we have with us right now. We already have calculated if at all in the respective currency, if the investment is made, the maturity amount of deposit is 20,20,511.61. So now we understand that the minimum rate of interest, minimum rate of interest in pound currency, that can be computed like this. maturity amount is equal to principal plus interest. Now what is maturity amount of deposit? It is 20 lakh 20,511.61. The principal amount is 20 lakh 173. 20 lakhs 173.52 plus. Now the rate of interest is required to be found. So how do we compute the interest amount? Interest amount is calculated as 20 lakh 173.52 into what is the rate of interest? Let us assign x variable to it. So into x upon 100, and what is the time period? Time period is 91 days. That's it. Now x will be calculated as balancing figure over here. So we understand that it is 20 lakh 20,511.61 minus 20 lakh 173.52 is equal to 20 lakh 173.52 into x upon 100, because the rate of interest is x, into 91 divided by 360. Now we understand that say 20,511.61 minus 20 lakh 173.52. So the amount of interest is 20,338.09. 20,338.09 is equal to 20 lakh 173.52 into x upon 100 into 91 divided by 360. Now this is supposed to be computed as balancing figure. So all other things will be transferred from left to right. So x is equal to 20,338.09 divided by 20 lakh 173.52 into 360 upon 91 into 100. Okay. So 20,338.09 into 360 into 100 divided by 20 lakh 173.52 and further divided by 91. It comes to 4.02%. So this is the minimum rate of interest that say you need to bargain with your bank. Only in that case, say you will be indifferent whether you make investment in the respective currency or you convert and you make investment. So this is the end of the answer that we have. There is an additional point which I want to tell you. Before I explain that additional point to you, just I would like to give you summary of the working that we have done. Dear students, you need to understand that over here, the question is providing the information like this: pound currency, then Swiss franc currency, and then euro currency. These three currencies are there. This is the holding company, this is subsidiary 1, and this is subsidiary 2. We have surplus at all the three places. The first simple alternative is that say we make investment in that respective currency only. Taking into account the forward exchange rate after 3 months, 91 days, we convert this Swiss franc into pound, we convert this euro into pound. Why? Because the pound is the holding company's currency. You can take frankly any other also, however taking pound would be simple. And then we make the computation that say what is the overall maturity amount of deposit if at all we go for this first alternative, in which we make the investment in the respective currency. whatever the maturity amount of deposit that say we get is 2020,511.61. Now instead of this, what we are thinking is that pound, Swiss franc and euro. Listen carefully. This is converted. So we get an amount of the principal amount in pound currency. Now this amount is invested for a time period of 91 days. The question says that say what is the minimum rate of interest that say you should bargain from your bank so that say the maturity amount of deposit is not lower than this amount. The maturity amount of the deposit is not lower than this amount. That is the way we are required to make the computation of the answer of the question. The only thing that say which I think is important for you as a student is to understand that say which exchange rate will be taken for the purpose of conversion. In case of forward exchange rate calculation, if it is low high, it is to be added. If it is high low, it is to be deducted, and so on. That is what say I think is important for you to understand in the question. Okay. Now the question ends over here, as I told you. However, an additional explanation that I want to give you is this. Suppose the question would have been asked further that do you advise the first alternative or the second alternative? The first alternative is making investment in the respective currency. That is the first alternative. And the second alternative is everything is converted into pound currency and then you make investment. Then answer of that can be given over here looking to the information which is provided here to us in this table. You can see that say the pound currency, then you have to see the amount, it is falling in which bracket? It is falling in this bracket. What is the rate of interest that say they are providing? 5.38%. 5.38% is exceeding 4.20%. 4.02. Yes, 4.02. As 5.38 is exceeding 4.02, so the company would be advised to convert the foreign currency amount into domestic currency and then you make investment. That is the way we are required to write the answer over here. If the question would have provided that so you give the decision. Now I would like to read one of the question which is there in your practice manual. When I speak practice manual, of course it is of the old syllabus. In that say the page number 12.41, question number 46. Say I want to tell you something, say by reading this question. Suppose you are treasurer of XYZ PLC in United Kingdom. XYZ has two subsidiaries. One is based on Amsterdam and another is in Switzerland. The Dutch subsidiary has surplus euro of 7,25,000 and it does not need it for the next 3 months, but which will be needed at the end of the period 91 days. Swiss subsidiary has again a surplus of 9,98,077. That is again will be needed after 91 days. XYZ PLC in UK has net balance of £75,000 that is not needed for the foreseeable future. Given the rates below, what is the advantage of the swapping euro and Swiss franc into sterling? Spot rate is given 91 days, forward points or swap points are given. Spot rate is given 91 days, the rate of interest are given. Forward points, swap points are given. Rate of interest is provided to us for the deposit. Pound currency, euro currency, Swiss franc currency. Like that information is given. See, what I want to tell you is that these kind of questions are there in the old practice manual. And there are fair chances that say these kind of questions can be there in your examination also. The chapters which are common for that, say you don't have to segregate the old syllabus and new syllabus. This is the suggestion that I have. The first thing. Second thing that I would like to tell you is this. Listen carefully to my point. The second thing that I want to tell you is that what happens importantly in this question, you are required to make a comparison. If at all you make the investment in the respective currency, and if at all you have the conversion into pound currency, in both the cases, what is the maturity amount of deposit that you compute? That is, if at all you make investment in the respective currency, and if at all you make investment by converting into pound and then you make investment. Like that, say you make a comparison and you select the better one. See, this is the kind of question which is there in your practice manual, and in examination what will happen? There will be a slight variation in the question. What happens that say the variation is that say you have been asked that say you compute for the pound currency what is the break-even rate of interest. The point at which say you are indifferent between investing in the respective currency and investing in the pound currency. So what happens that say over here, this is what say the option number 1, you make investment in the respective currency. This is the option number 2, in which say you make investment by converting into pound. Now this rate of interest which is given to us in this example as well as the example that say we have recently done. But this time the question says that so you compute this break-even rate of interest. And listen to my point carefully. I have number of times observed that so the students fail to understand this twist of the question. See, the question is almost the same. However, the question that we have recently done of the recent RTP, and there are fair chances that say these kind of questions there can be there in examination. What is the twist? The twist is you are required to find the break-even rate of interest. So you are required to take into account the maturity amount of deposit is this, investment is this amount, and you compute that what is the minimum rate of interest that say we should bargain. That is again basically this rate of interest is required to be found. This is what say we understand. So just be careful from examination point of view. One more small clarity, that's over here the rate of interest which I have found 20338.09 into 360 into 100 divided by 20 lakh 173.52 91, that comes to 4.022. That is the way we will write the answer. Why? Because the question is specifically providing that so you are required to write the answer up to 3 decimals. That is the reason. So just be careful for this kind of small points. If at all you have been provided with this kind of points, then in that case it is mandatory for you to write the answer accordingly. So just be careful for that. The final answer has to be provided say into 3 decimals. Dear students, I would like to tell you that say we are able to provide at Navkar all these things to you under the guidance of Hitesh sir, under the guidance of Dhaval sir, wherein all these cross verifications are provided to you. And this is the value addition that say we can provide to you at Navkar. Next question. It is a question from the interest rate risk management. First of all, let us have understanding of the question. Two companies ABC and XYZ approach DEF Bank for FRA forward rate agreement. They want to borrow a sum of rupees 100 crore after 2 years for a period of 1 year. After 2 years for 1 year. The bank has calculated yield curve of both the companies as follows. Information is provided for XYZ and ABC. 1 year, 2 year and 3 year. Difference in the yield curve is due to lower credit rating of ABC in comparison to XYZ. You are required to calculate the rate of interest DEF Bank would quote under 2V3 FRA. It is 2 into 3 FRA. Using the company's yield information as quoted above. Then second part of the question is given. Second part of the question I would like to read slightly later on. I would like to focus on the first part of the question initially. Everybody is requested to pay proper attention in solving this question. See, over here we have been provided with the information like this. There is a concept which is connected over here is forward rate agreement. At the same time, say there is the forward rate calculation, that is called expectation theorem, which we are required to apply over here. What is the question? Let us understand the question. The question is providing the information. The question is providing the information that say there are two banks, that is there are two companies, ABC and XYZ. I am talking about ABC because XYZ is copy paste. Nothing is great to understand in case of XYZ. Understanding one company will be absolutely sufficient. Then we will switch over to the second company. So there is a company called ABC. It is approaching to DEF Bank and asking for forward rate agreement. Now what happens in case of forward rate agreement? Let us understand. Let us assume that the today's date is 1st of January 2020. Then 31st of December 2020 is end of year 1. 31st of December 2021 is end of year 2. And 31st of December 2022 is end of year 3. Like that, say there are 3 years for which we are required to have a conversation. Basically, the company wants to have borrowing at the beginning of the 3rd year for the 3rd year. It wants to borrow an amount of rupees 100 crore at this point of time. That is 1st of January 2022. We understand that of course the rate of interest keep on fluctuating. So basically this company has a fear that at this point of time the rate of interest may be substantially more. That is the reason, so today itself it wants to have a forward agreement. Forward agreement means say an agreement in which say there is a commitment that say this is the rate at which say I will borrow from you. That is what we understand is a forward agreement, and this agreement is for the rate of interest, so it is forward rate agreement. Okay, so this is what say we understand is basically the transaction. After 2 years, for 1 year you want to borrow. How do we come to know about that? Because you can see that so the information is provided to us that 2 into 3 FRA. 2 into 3 stands for after 2 years for 1 year. 2 into 3. It means that after 2 years for this 1 year. This is the way we are supposed to have the borrowing of the funds. Okay. Coming back to the point. As far as the bank is concerned, so the bank has given a quotation like this. What kind of quotation is given by the bank? I explain that to you. If at all you borrow right now, I am talking about the first, that is XYZ, or we can talk about any of the company. Let us say XYZ. XYZ, then the bank has given a quotation to XYZ that if at all you borrow today for a time period of 1 year, then we will charge you a rate of interest of 3.86%. If you borrow today for 2 years, then we will charge you the rate of interest 4.20% per annum for 2 years. If you borrow today for 3 years, then in that case we will charge you 4.48% per year for 3 years. That is the way the information is provided to us about the yield curve. That is the way the information is provided to us about the yield curve. Okay. Now coming back to the point. So first year, second year and third year, this is given a name as spot rate. 3.86, 4.2 and 4.48. 3.86, 4.20 and 4.48. Okay. If at all you borrowed today 1 rupee, then at the end of year 1 you have to pay 1.0386. If you borrow 1 rupee today, then at the end of 2 years you have to pay 1.085764. And if at all you borrow 1 rupee today, then at the end of the 3 years you have to pay 1.1405. Over here also I am restricting to the 4 decimal 0858. Okay. So now what happens that if you borrow for 1 year, then for every 1 rupee that you borrow, this is the repayment. You borrow for 2 years, then for every 1 rupee that you borrow, this is the repayment. It is calculated as 1.042 raised to 2. If you borrow 1 rupee today for 3 years, then in that case at the end of the 3 years you are required to make the repayment of loan like this. Okay. Now the forward rate of interest is very simple. Remember that the forward rate of interest will be found like this. If at all the forward rate of interest for the third year, how it is calculated, I explained that to you. If at all you borrow for 2 years and then again that amount is borrowed for 1 more year, what should be the rate of interest for the third year, so that the repayment of the loan is same if you would have borrowed the funds directly for 3 years. I repeat it again. See, this is the important point that you need to understand. What is the third year forward rate, friends? The third year forward rate is calculated like this. Today you borrow for 2 years. Whatever the amount that you are required to repay at the end of the second year, to repay that, further you borrow for 1 more year. What should be the rate of interest for the third year, so that your repayment of the loan is same as if you would have borrowed directly for the 3 years. That is the way we are required to make the computation of F3, that is forward rate for the third year. So we understand it is like this. Listen carefully. It is 1 plus spot for the second year raised to 2 into 1 plus forward for the third year raised to 1 is equal to 1 plus spot for the third year raised to 3. That is a simple formula. You borrowed an amount for 2 years. Now to repay that, you borrow once again for 1 year. Then what should be the rate of interest for that year, so that your repayment of the loan at the end of the third year is same if you would have borrowed the funds directly for 3 years. That is the way the third year rate of interest is calculated. This is a simple formula that we have. So we can write the heading, calculation of forward rate of interest. So we can say that now 1 plus F3 raised to 1 is equal to 1 plus S3 raised to 3 divided by 1 plus S2 raised to 2. Okay, this is taken in the division. Okay, so now this answer is required to be computed for 2 companies. The first one is XYZ, another is ABC. You can see that they have changed the sequence ABC and XYZ to XYZ ABC. In this question it does not make any difference. However, sometimes it will make a difference. So just be careful. So over here XYZ and ABC, let us see how to make the calculation of answer. One is XYZ. And the next is ABC. For XYZ, the answer will be calculated like this. It is 4.48 and then it is 4.20. So 1.0, 4.48 percentage raised to 3 divided by 1.042 raised to 2. Whatever the answer that we have, from that one is subtracted. For ABC we will have the same thing, friends. For ABC it is this two rate of interest is required to be considered, 5.78 and 5.48. So 1.0578 raised to 3 divided by 1.0548 raised to 2. Whatever the answer that we have, minus 1. So 5.78 and 5.48. Okay. So now (1.042) raised to 2 is 1.0858. And the numerator is 1.0448 to 3, 1.1405. Minus 1, 1.1405 divided by 1.0858. So it is 5.04. 1.5.04 minus 1. 0.0504, that is 5.04 percentage. That is the way the rate of interest will be found. For the next, similarly we are required to do answer 1.0578 to 3, 1.1836. (1.0548), so 1.1126. Whatever the answer that we have, minus 1. 1.1836 divided by 1.1126. So 0.0638. 1.0638 minus 1. So it is 0.0638, that is 6.38 percentage. That is the way the rate of interest are provided to us. So DEF Bank will tell to XYZ the forward rate of interest as 5.04 percentage, and DEF Bank will give the forward rate of interest to ABC 6.38 percentage. Next, second part of the question. Suppose bank offers interest rate guarantee for a premium of 0.1% of the amount of loan. You are required to calculate interest payable by XYZ Limited if the interest rate in 2 years turns out to be 4.5% and 5.5 percentage. That is the question. Now second part of the question is having an additional point. What is that additional point? Let us understand. The question is providing that say you are required to make the computation from XYZ Limited point of view. So we are required to focus on the XYZ Limited rate of interest, which is calculated by us. It is 5.04%. Everybody is requested to pay attention, understanding the concept and then calculation of the answer. Second part of the question. Now what happens that this is year 0, this is end of year 1, end of year 2 and end of year 3. Now what would be the rate of interest prevailing at this point of time? For that say there is an uncertainty from this time period point of view. So XYZ Limited is entering into a forward rate agreement in which it gets a committed rate of interest of 5.04%. At the same time, XYZ Limited thinks, listen carefully, that if at all the rate of interest is up, is more than 5.04%, it's really good that I have entered into the forward rate agreement. I feel very safe when the rate of interest is higher than 5.04%. I feel very good. However, if the rate of interest is less than 5.04%, then in that case, I will repent. Oh, I have to pay rate of interest 5.04%. Like that say, I will have like a feel that say I am incurring a loss. See, actually there is no loss. But yet I feel that say I have to pay interest at 5.04%. Because there are always two sides of a coin. Like you have advantage when the rate of interest is more than 5.04. At the same time you are required to sacrifice when the rate of interest is less than 5.04. So there is again a solution for this. What is the solution? Solution is like this. So now XYZ Limited is yet want to have security in that situation. So what XYZ Limited is telling to DEF Bank, listen carefully. XYZ Limited is telling to DEF Bank that say, I am ready to pay you 0.1% flat. I am ready to pay you 0.1% flat at this point of time. You give me a right to borrow at this rate and not an obligation to borrow at that rate. I repeat my explanation. XYZ Limited is telling to the DEF Bank that say you do one thing. That say I am going to give you 0.1% flat. As against that say you give a right to me that I can borrow at this rate and not an obligation to borrow at that rate. So what happens at say two rate of interest have been provided to us. Listen carefully. 4.5% and 5.5%. What XYZ Limited will do? If at all the rate of interest is 4.5%, it will allow its right to borrow at 5.04% to lapse. It will borrow at the rate of 4.5%. If the rate of interest is 5.5, in that case it will borrow at 5.04%. In either of the situation, listen carefully, in either of the situation, it is required to pay premium of 0.1%. So we'll have to work out the answer like this. Calculation of total cost to XYZ in both the situations. Okay, rate of interest provided to us as 4.5 and 5.5. 4.5%, 5.5%. In both the situations, you are required to make payment of premium. What is the amount of premium? It is 100 crore into 1%. That is what's the premium which is required to be paid. It is 0.1%. 100 crore into 0.1 percentage. That comes to an amount of 10 lakhs. Now importantly, in case of 4.5 percentage, you are required to make payment of interest at the rate of 4.5 percentage, because you will allow your right to lapse. See, the premium is required to be paid, interest rate guarantee premium or whatever may be the charges or any other name, that is required to be paid unconditionally. Now what will happen? You will compare that, say what is the rate of interest prevailing in the market and what is the forward rate of interest. If the forward rate of interest is more, then in that case you will allow this right to lapse. So now you are required to pay interest at 4.5 percentage. So it is 100 crore into the rate of interest is provided to us as 4.5 percentage. So 100 crore into 4.5%. So it comes to 450 lakhs. If at all the rate of interest is 5.5 percentage, then in that case importantly you are required to pay interest at 5.04 percentage. So 100 crore into 5.04 percentage, that is the forward rate of interest. So it is 504 lakhs. That is the way the total cost will be calculated. In the first case it is 460 lakhs. In the second case it is 514 lakhs. I am just writing a small note for the answer, only for understanding purpose. In this question, from XYZ Limited point of view, comma, we have to compute total cost, comma, consisting of interest and premium. Full stop. XYZ Limited has to pay premium unconditionally. Full stop. With that, XYZ has a right to borrow at the rate 5.04 percentage. Full stop. Not an obligation to borrow at the rate of 5.04%. So, if market rate of interest is less than 5.04%, comma, in that case XYZ will allow its right to lapse, and it is required to pay interest at the rate prevailing rate of interest. Full stop. This is the way we are required to answer this question. So there is a combination of the concepts: forward rate agreement, calculation of the forward rate that you study in your security analysis, security valuation. Then interest rate guarantee is a new point that we have again. Question number 12, next question. Following information is given in respect of WXY Limited, which is expected to grow at the rate of 20% per annum for the next 3 years, after which the growth rate will stabilize at the rate of 8% per annum normal level. So for the first 3 years, growth rate is 20%. Later on, the growth rate will be 8% for perpetuity. For the year ended 31st of March 2014, information is given. Friends, this is considered to be year 0 for the purpose of financial management. Information is given about the revenue, COGS, cost of goods sold, operating expenses, capital expenditure, depreciation, which is included in the operating expenses. So as far as the operating expenses are concerned, it is divided into two parts: 2250 minus 600. So it is 600 is the depreciation and 1650 is other than depreciation. During high growth period, that is, they are talking about this 20%, revenue, earning before interest and taxes, it means operating income will grow at the rate of 20% per annum, and capital expenditure net of depreciation will grow at the rate of 15% per annum. Okay, so the revenue and operating income will grow at the rate of 20%. However, capital expenditure net of the depreciation will grow at the rate of 15%. From 4th year onwards, normal growth rate for a revenue, operating income will grow at the rate of 8% per annum, and incremental capital expenditure will be offset by the depreciation. Means whatever is the capital expenditure and the depreciation, both of them are going to be same. During both high growth and a normal growth period, net working capital required will be 25% of the sales. The weighted average cost of capital of WXY Limited is 15%. Income tax rate is only 30%. You are required to compute the value of WXY Limited using free cash flow to firm and weighted average cost of capital methodology. Present value factor at 15% for the 3 years are as follows. Year 1 to year 3, discounting factors information have been given to us. Again, this is a very good question that we have of the institute. Dear students, before I forget, just I want to tell you the previous question that we did was again there in the institute material earlier. It is old revisionary test paper, November 2014. In that question number 1. Again, it was there in May 2019, yes, old revisionary test paper as question number 6. It is there in the practice manual also. Practice manual is of course old. In that, question number 79, page number 5.74. That is the way, say, this question was there in the old material. Now it is in the new material. Now I need not to tell you that old PM is important, is relevant for the chapters which are common. Let us come back to this point. Over here friends, the question says that you are required to make the computation of the value of the firm using the free cash flow for the firm approach. Very good clarity is made in the question that you are required to use the weighted average cost of capital for the purpose of calculation of the answer. Taking into account the information given, we will make the calculation of NOPAT, that is net operating profit after taxes, minus capital expenditure net of the depreciation, minus working capital investment, and based on that we will make the computation of the free cash flow. Whatever the amount of the free cash flow that you are going to receive, the same will be discounted in present value term. Present value of the future cash flow is the current value of the firm. That is a simple sequence in which we are required to calculate the answer. So let us start with the working. The working notes that we need to prepare over here, the sequence in which we are doing answer is I think important. See, the question is not very difficult. However, what I think is that you should be clear as a student that what is the sequence in which we should be calculating the answer of the question. Only in that case you will be able to execute properly the answer. So now understand carefully friends, the sequence in which we will be doing answer is like this. We have been provided with the information that during high growth period, revenue, operating income will grow at the rate of 20%. Further, we have been provided that the working capital is 25% of the revenue. Then capital expenditure net of the depreciation will grow at the rate of 15% per annum. So we will prepare the working notes like this. Listen carefully. It is answer of question number 12 I think. Yes. Answer of question number 12. Dear students, my suggestion to do the answer is in this way. We can do step number 1 or working note number 1, either of the thing that you can mention is capital expenditure net of depreciation. Step number 2 is working capital change. As far as the first step is concerned, in that we are required to prepare only for the 3 years, because from 4th year onwards, whatever the capital expenditure and the amount of capital expenditure, that is the amount of depreciation, both of them are going to offset one another. Second is working capital change year 1 to year 4, that will prepare. The third is what we can make the computation is the net operating profit after taxes for the year 0. That is, we understand that the earning before interest and taxes into 1 minus t. We'll do it for the year 0 because it is going to grow at the rate of 20% for the first 3 years, and then it is going to grow at the rate of 8%. Then the fourth step is calculation of free cash flow for the firm. This will be computed. This will be computed for the year 1 to year 4, taking into account net operating profit after taxes, taking into account the working capital change, taking into account the capital expenditure net of the depreciation. That is the way the free cash flow for the firm will be calculated. Then in step number 5 or working note number 5, we will make the computation of P3. What does the term P3 mean? 4th year onwards for perpetuity, whatever amount that you are going to receive, all of them will be discounted to end of year 3. That is considered to be the P3 value. And the last step, in that will compute the value of the firm. It means that at the end of year 1 to end of year 3, the amount of the cash flow will be discounted. Again, P3 value will be discounted, and that is the way value of the firm will be calculated. This is the simple sequence in which you can do the answer. So let us now execute the answer. I have mentioned it for many a times, yet I think that I need to mention it again. That see, as a student, you may be able to understand a sequence. However, in examination, you will not be able to execute the sequence unless you have the writing practice. Make sure that you have good writing practice. Okay, now I am starting one by one. Step number 1, calculation of, I think, capital expenditure net of the depreciation. Capital expenditure net of depreciation. This is year 1 to year 3. So first year, second year and third year. We have been provided with the information that, say, for the base year the capital expenditure is 750 crore. For the base year depreciation is 600 crore. So for the base year, year 0, capital expenditure net of the depreciation is 150 crore. Dear students, it will grow at the rate of 15%. So over here we will mention like this, that 750 minus 600, so it comes to 150, multiplying with 1.15. So over here it is 750 minus 600, that is 150 into 1.15, that is 172.5 at the end of first year. In second year, friends, what will happen? It is like 172.5 into 1.15, or otherwise whatever the year 0, that is 150 into 1.15 raised to 2. That is the way for the second year we will show. It is 198.38. For the next year it is 198.38 into 1.15. So 198.38 into 1.15, that comes to 228.14. This is what we are required to show from end of year 1 to end of year 3. So this is the first, capital expenditure net of the depreciation. Next is the working capital change. So step number 2, calculation of working capital change, or we can say it is working capital investment. In that, year sales, that is the revenue, based on that working capital, because working capital is 25% of the revenue, and then working capital change, that is end of year 1 will be compared with year 0, end of year 2 will be compared with end of year 1, and so on. So the comparison will be made. This is the way the working capital change will be found. As far as year 0 is concerned, we can see that the amount of sales is provided as 7,500 crore. So in the year 0 it is 7,500 crore. Now end of year 1 it is 7,500 into 1.20 raised to 1, that comes to 9,000 crore. In the second year it is again 9,000 crore into 1.20 raised to 1 again, that is the way it is growing. So it is 10,800. In the third year it is 10,800 into 1.20 raised to 1 again, it is 12,960. In the fourth year, listen carefully, 12,960 into 1.08. Okay, why? Because after 3 years the growth rate is 8%. So it is 13,996.8. This is the way we will have the sales revenue from end of year 1 to end of year 4. Now what is working capital? Working capital is 25% of the revenue. So I am writing over here 25% in the bracket. So 25% into 7,500, that comes to 1875. Then 25% of 9,000, that comes to 2250. Then 25% of 10,800, So it comes to 2700. Then 25% of 12,916, it comes to 3240. Then 25% of 13996.8, it comes to 3499.2. Okay. Now listen carefully the next working. Next is the working capital change. Now as far as the working capital change is concerned, in that we are required to show the answer like this. See, the working capital requirement at the end of the first year is 2250, otherwise it was 1875. So what will happen? It is 2250 minus 1875. So it increases by 375, friends. Then it is 2700. Earlier it was 2250. So again there is an increase. How much? 450. This is an additional investment to be made at the end of every year. Next, 3240 minus 2700, 540. For the fourth year, 3499.2 minus 3240, so it comes to 259.2. This is the way we are required to calculate the increase in the working capital. Now let us have a summary of this working that we have done, friends. For the base year, the sales is 7500 and the working capital requirement at the rate of 25% is 1875. End of year 1, sales increases by 20%. Again 25% of that is the working capital requirement, that is 2250. So there is an increase in the working capital by 375. Similarly, for the second year, for the third year, for the fourth year, we have computed that, say, what is the working capital requirement? It is 25% of the revenue. So it is 9000 into 25%. It is 10,800 into 25%, and so on. Whatever the working capital that we require at the end of this year minus the investment that we had at the beginning of the year, difference of that is required to be invested at the end of each year, starting from end of year 1 to end of year 4. Next, let us see the sequence calculation of the net operating profit in the year 0. Step number 3. Calculation of NOPAT, net operating profit after taxes, in the year 0. Okay, net operating profit after taxes. We can say it is earning before interest and after taxes. Let us see the information provided to us. Revenue is 7500 crore. So the sales is 7500 crore. COGS is 3000 crore. COGS is 3000 crore. Then operating expenses 2250, including depreciation. In bracket I am writing including depreciation. Next is capital expenditure. So now we understand that this is the point at which we have the earning before interest and taxes. It is 7500 minus 3000 minus 2250. It comes to 2250, friends. Income tax rate, I suppose it is 30%. So the tax 675. So earning after taxes, that is earning before interest and after taxes, is 1575. It is 1575. This is of base year, year 0. So over here for the base year we have computed what is the net operating profit after taxes. Sales 7500 minus COGS 3000 minus operating expenses including depreciation 2250 is operating income. At this point of time income tax is deducted, so we get NOPAT, net operating profit after taxes. It is 1575. Next, we are required to make the computation of the free cash flow for the firm in our step number 4. Let us see that's the step number 4, how to make the computation of answer. Calculation of free cash flow for the firm. This is required to be computed, say, from end of year 1 to end of year 4. Listen carefully, that's how it is computed. First year, second year, third year and fourth year. We start with the NOPAT, net operating profit after taxes. We already have the base year value. Yes, this will grow at the rate of 20%. Okay, it will grow at 20% for the first year, for second year, for third year. Then it will grow at the rate of 8% in the fourth year. That is the way for the first 4 years it will be calculated. Then we will show capital expenditure net of depreciation. We will show capital expenditure net of depreciation, which we have calculated over here. So it is first year cash outflow 172.5, second year it is 198.38, third year it is 228.14. So usually you add back depreciation and you show capital expenditure outflow. Instead of that, say net of that is shown over here from end of year 1 to end of year 3. I repeat that again. Usually what you do, you add depreciation and you deduct the capital expenditure. Instead of showing two items, only one item is shown. That's the reduction of the capital expenditure net of the depreciation from first year to the third year. Okay. Then we will show the working capital investment. Working capital investment, it is first year end to fourth year end. Year 1, year 2, year 3 and year 4. That is for 4 years it will be shown. Afterwards we will have free cash flow for firm. This will be calculated, say, for the first year to the fourth year. That is the way we are required to make the calculation of answer. So let us start calculating the answer. For the first year it is 1575. It is 1575 into growth rate is provided to us as 20% for the first 3 years. So raised to 1. So it is 1890. Then it will grow further at the rate of 20%. So it is 1890 into 1.20 raised to 1 again, 2268. Then 2268 into 1.20, that is 2721.60. Then it will grow at the rate of 8%. So it is 2721.6 into 1.08. Okay, this is important. Into 1.08. So 2939.33. 2939.33. This is what we will have year 1 to year 4. Capital expenditure net of the depreciation. For the first year it is 172.5, second year it is 198.38, and last year it is 228.14. So over here it is 228.14. First year it is 172.5, second year it is 198.38. Fourth year onwards it will be 0. Working capital investment, that is again important. First year it is 375, second year it is 450, third year 540, and last year 259.2. So over here it is 259.2 for the last year. First year it is 375, second year it is 450, third year it is 540. That's it. Now we got the free cash flow for the firm. First year 1890 minus 172.5 minus 375. So it is 1342.5. Next year it is 2268 minus 198.38 minus 450. So it is 1619.62. Next 2721.6 minus 228.14 minus 540. So 1953.46. 1953.46. Last year it is 2939.33 minus 259.2, that is 2680.13. Okay, this is the way we will have the cash flows to be shown. So for the fourth year it is 2939.33 minus 259.2. So 2680.13. Okay, this is the way the free cash flow for the firm can be calculated. Then step number 5, in which we will make the calculation of P3. What is P3? End of year 4 onwards for perpetuity, whatever the cash flows that the business is going to generate, all of them will be discounted to the third year end. So we understand that it is free cash flow for firm for the fourth year divided by weighted average cost of capital minus growth rate. Fourth year cash flow is this amount, 2680.13. Divided by weighted average cost of capital is 15%, minus growth rate is 8%. So it is 2680.13 divided by 0.07. So 2680.13 divided by 0.07. So 38,287.57. This is of year 3 end. Okay, now the last working, that is calculation of value of the firm, that is step number 6. In that, first year, second year and third year. First year cash inflow is 1342.5, second year it is 1619.62, third year it is 1953.46. Then this will be added to the third year cash flow. That is the way we are required to compute the free cash flow for the firm. 1, 2, 3 in the third year will add P3 value. then it will be discounted at the rate weighted average cost of capital 15% and will compute the present value. The present value of the future cash flow is what we understand is the value of the firm. So first year it is 1342.5. 1342.5 first year. Second year it is 1619.62. 1619.62. Third year it is 1953.46. 1953.46 plus 38,287.57. 38,287.57. So 1953.46 plus 38,287.57. So it is 40241.03. 40,241.03. Now it is discounted at the rate of 15%. First year factor is 0.8696. Second year 7561. Third year 6575. Present value 1342.5 into 0.8696. So 1167.44. 1619.62 into 0.7561. 1224.59. 40241.03 into 0.6575. It is 26,458.48. And this is the way simple value of the firm will be calculated. 1167 1167.44 plus 1224.59 plus 26458.48. So 28,850.51. This is the value of the firm. This is the way the simple value of the firm is calculated. Let us have a quick revision of the working that we have done. See, over here the question is about the calculation of the value of the firm using very clearly information given. That's why you are required to adopt the free cash flow for the firm approach. So first of all, we have made the computation of the capital expenditure net of the depreciation. This is computed only for the 3 years. Why? Because from 4th year onwards, the capital expenditure is going to offset the depreciation. Working capital is going to be 25% of the revenue. So we have computed the working capital requirement for the first 4 years. Why? Because for the first 3 years, the sales will grow at the rate of 20% and then sales will grow at the rate of 8%. Base year net operating profit after taxes, because it is again going to grow at the rate of 20% for the first 3 years and then 8% from 4th year onwards. Free cash flow for the firm. Just I would like to clarify that as far as the first 3 working notes are concerned, for that, so the sequence is not going to make any sense. You may change the sequence 1, 2, 3, 1, 3, 2, 3, 2, 1, anything. Because these 3 working notes or these 3 steps are independent to one another. 4th step cannot be done unless we have done the first 3 steps. Free cash flow for the firm for year 1 to year 4. P3, again that sequence you cannot change P3 has to be computed once you have computed the free cash flow for the firm. And of course, the last step is the value of the firm. Dear students, this question is again from SFM old syllabus. Question number 4B, and it was asked in the examination of May 2014, and it was asked for 8 marks. Again, whatever we tell you from Navkar is what you can see is consistently proven to be correct. Old syllabus question, question number 4B, and it was asked in examination for 8 marks. So you need to be prepared that this kind of question can be asked for 8 marks in examination. Next question, question number 13. Following is the balance sheet of Grapefruit Company Limited as on 31st of March 2019. Equity share capital 600 lakhs, preference share capital is 200 lakhs, 13% debentures is again 200 lakhs, debenture interest accrued and payable is 26 lakhs, loan from bank 74 lakhs, trade creditors 340 lakhs. On the asset side, we have the land and building 200 lakhs, plant and machinery 300 lakhs, furniture and fixtures 50 lakhs, stock 150 lakhs, data 70, cash at bank 130 lakhs, important preliminary expenses 10 lakhs. Cost of issue of debentures is again important 5 lakhs. Profit and loss account on the asset side means there is a loss of 525 lakhs. The company did not perform well and has suffered sizable losses during the last few years. However, it is felt that the company could be nursed back to health by proper financial restructuring. Consequently, the following scheme of reconstruction has been drawn up. First, equity shares are to be reduced to ₹25 per share fully paid up. Preference shares are to be reduced with a coupon rate of 10% to equal number of preference shares of ₹50 each fully paid up. Debenture holders have agreed to forgo the accrued interest due to them. In future, the rate of interest on the debenture is reduced to just 9%. Trade creditors will forgo 25% of the amount due to them. The company issues 6 lakh equity shares at the rate of ₹25 each, and the entire sum was to be paid on application. The entire amount was fully subscribed by the promoters. Land and building was revalued at ₹450 lakhs. Plant and machinery was to be written down by 120 lakhs, and provision of 15 lakhs had to be made for bad and doubtful debts. You are required to show the impact of financial restructuring on the company's activities. Then the second part of the question is there. Prepare a fresh balance sheet after the reconstruction is completed on the basis of above proposal. This is a very simple question, and you can understand that it is similar to whatever internal reconstruction that you were studying at your IPCC or your intermediate level. There is no change. It is exactly the same thing that you have studied. So now over here what happens is there are two things. One thing that we understand is, on one side we will be able to get the capital reduction account credited by debiting the equity share capital, by debiting the preference share capital, by debiting the trade creditors, and so on. So there is a kind of contribution which these finance providers has provided, and then it is going to be utilized. That is what we are required to show in the very first part of the question. In second part of the question, we are required to show the balance sheet. That is the way we are required to do this very simple question. Again friends, this question is from the SFM old syllabus. This question has been asked in examination. Yes, it has been asked in examination for 2 times, November 2011, May 2017. It was asked for 10 marks and it was asked for 8 marks. It is there in the revisionary test paper of the old syllabus, it is there in the practice manual, it is there in the study material of the old syllabus. Everywhere it is there. And now it is the part of the new syllabus. So over here, let us see that how to make the calculation of answer. And sometimes students are really lucky like me, wherein this kind of questions have been asked in examination and you pass your examination. So now let us start doing answer. Over here we understand that we are required to do the answer like this. It is answer of question number 13. Answer of question number 13. In the first part of the question says that you are required to show the effect, that is show the impact of the financial restructuring. So basically what happens that you are able to get the contribution, so there is a reduction of the liabilities. So that is what a kind of the inflow that you have. At the same time, so you are supposed to revalue the assets as per the information provided to us. That is, land and building is required to be revalued. So all those things are required to be considered by us. So over here we'll have first of all answer of the first question. In that, so the impact of restructuring. In that, first of all we'll show reduction in liabilities. As far as the equity share capital is concerned, it will be reduced to rupees 25. Equity share capital value right now is an amount of 600 lakhs. And it has a face value of rupees 100. So from 100 it reduces to 25, so it reduces by 75. So reduction in equity share capital. It is 600 lakhs divided by 100 into 100 minus 25. So 600 lakhs divided by 100, 6 lakhs into 75, that is 450 lakhs. Next is the reduction of preference share capital. As far as the preference share capital is concerned, it is right now how much? It is right now an amount of 200 lakhs. 100 rupees is the face value. Then it reduces to 50 rupees. So it is 200 lakhs divided by 100 into 100 minus 50. So we understand that the 200 lakhs divided by 100, that comes to 2 lakhs into 50. So reduction in the preference share capital by 100 lakhs. Next is debenture holders have agreed to forgo the interest due to them. So debenture interest is an amount of 26 lakhs. So debenture interest an amount of 26 lakhs. Next, in future the rate of interest on the debenture is to be reduced to 9%. So just be careful that say when we are going to prepare the new balance sheet, then in that case the rate of interest for the debentures will be shown not 13% but 9%, because the new debentures having rate of interest of 9% are issued and the existing debentures of the 13% have been withdrawn. Trade creditors will forgo 25% of the amount due to them. So reduction of the trade creditors we have been provided with the information. Trade creditors is an amount of 340 lakhs. So over here 340 lakhs into 25%. It has been given that say they are ready to forgo 25% of the amount due to them. So 340 into 0.25. It is 85 lakhs. Very simple. Next, the company issues 6 lakhs equity shares at the rate of 25 rupees each, and the entire sum was paid on application. So this will have the effect when we prepare the new balance sheet. The entire amount was subscribed by the promoters. This is irrelevant. Generally we understand that so the promoters will only now make investment over here. Land and building will be revalued at 450 lakhs. The current value of the land and building is given as 200 lakhs. So from 200 it will increase to 450. So there is a gap of 250 which is filled up. So reduction of the liabilities and then increase in value of assets. In that we will write land and building. It is revalued at 450 minus the current value is 200. So there is an upward valuation of 250. So dear students, we understand that till this point of time the information is given. Let's say from where we will be able to get the values. Then the utilization is there. So at this point of time we can say that say the impact of restructuring in that this is the total amount which is available for the purpose of writing of all the assets. So the total of this is coming to 450 plus 100 plus 26 plus 85 plus 250. So we understand that so this is the total amount that we have 911 total. In short, so this is the amount which is credited to the capital reduction account. So this is what say we are able to get. Now utilization. Let us see that say the information is given that say the plant and machinery will be written down by 120 lakhs. So it is written down by 120 lakhs. So we understand that say the reduction in asset value, comma, write-off of loss in that reduction in value of plant and machinery, it is 120 lakhs. Then information is given that the provision of 15 lakhs had to be made for bad and doubtful debts. So provision for doubtful debts, it is an amount of 15 lakhs. After that, we can understand that whatever the fictitious assets which have been given and whatever the loss which have been given are required to be written off. Preliminary expenses 10 lakhs. Next, cost of the issue of debenture is 5 lakhs. That is also supposed to be written off. Next, loss 525 lakhs. So whatever the credit side balance that we have of 911 lakhs will be used. So what is the amount which has been used? 120 plus 15 plus 10 plus 5 plus 525. So it comes to 675. This is the amount which has been used. So out of 911, 675 is used. So we understand that 236 will be transferred to the capital reserve. So the amount transferred to capital reserve, it is 236. So it is 911 minus 675. That is the way amount transferred to the capital reserve will be calculated. Then in the second part of the question, we will prepare the balance sheet. So this is the amount 236 that will be transferred to the capital reserve. Next, we are required to prepare the balance sheet. Name of the company is Grapefruit Company Limited and the date is 31st of March 2019. So we understand that balance sheet of Messrs. Grapefruit Company Limited as on 31st of March 2019. And we understand that this is what basically the balance sheet that we prepare after reconstruction. It is after reconstruction. Liability side amount, asset side and amount. Dear students, as per institute suggested answer, it is absolutely okay if at all you prepare the balance sheet into this T format. You don't have to prepare the balance sheet in the vertical form necessarily, okay? Because over here in financial management we are having the focus on the decision making, we are having the focus on the special area and not the account presentation. Okay, we understand that right now the number of equity shares were 600 lakhs divided by 100, so it is 6 lakhs, and there is an additional issue of equity shares. It has been provided over here to us like this, that the additional 6 lakh shares have been issued. So total it comes to 20, that is 12 lakh shares. So we'll have the equity share capital, in that 6 lakhs plus 6 lakhs, that comes to 12 lakhs into 25 rupees per share. that comes to 300 lakhs. And so on, we are required to prepare the balance sheet. Next is preferential capital. Right now the preferential capital that we have is 200 lakhs, face value is 100. So 200 lakhs divided by 100, that will give us the number of preference shares 2 lakhs. The face value has reduced to 50. So we will have 200 lakhs divided by 100. So the number is 2 lakhs and the face value is 50. 2 lakhs into 50, that comes to 100 lakhs. Next, 13% debentures is now, as we have discussed, it will reduce to 9%. So 9% debentures, I think that the amount is 200. Yes, debenture interest entirely they have forgone, so ignore it. Loan from the bank, that is an amount of 74 lakhs. No information is given about the same. It means that it is going to remain as it is. That is loan from bank. It is 74. Next is trade creditors 340. However, they have agreed to forgo a partial claim. So trade creditors, I think that they have forgone 25%, so minus 25%, so it comes to 255. This is the way we will have the liability side. On the asset side, let us see, we will have the land and building 200, however it has been revalued. So it has been revalued to, I think, 450. Yes, land and building is revalued to 450. Next, it is, I think, plant and machinery, which has been written down by 120 lakhs. So 300 minus 120, that comes to 180. Next is furniture and fixtures, no information is given, so as it is, furniture and fixtures 50 lakhs. Next is inventory stock, no change, 150. So inventory 150. Next is debtors, total is 70. However, there is a provision that we have made for the doubtful debts. So we will mention the debtors as 70 minus 15, that comes to 55. Next, cash and bank, that we can keep as the balancing figure, or otherwise we can compute it like this, 130 lakhs plus. We understand that the directors have made an application for the equity shares and they have made the entire payment. So it is 6 lakhs into 25 rupees per share. So 6 into 25, that is 150 plus 130, that comes to an amount of 280. This is the way we'll have the asset side of the balance sheet. So now 300 plus 100 plus 200 plus 74 plus 255. So the liability side total is 929, and one more thing that we are required to add over here is the capital reserve. So the amount of capital reserve is 236. We understand that the excess amount 236, so that comes to 1165. So the liability side total is 1165. Then asset side 450 plus 180 plus furniture and fixtures 50 plus stock 150 plus debtors 55 plus cash and bank 280. So it is again 1165. This is the way we are required to prepare the small balance sheet. So we are required to prepare the simple balance sheet, and with that, so you will be able to get the full marks. This is 2 lakhs into 50 rupees per share, and this is what we understand is a capital reserve. And there is no requirement of the vertical balance sheet. Next question. Yes, here is the next question. Question number 14A. Explain the key decisions that fall within the scope of the financial strategy. Which are the key decisions? Here is the answer. The key decisions falling within the scope of the financial strategy are financing, investing, and dividend decisions. And next is the portfolio decisions. Friends, these are nothing else but these are the chapters that so you already have studied at your IPCC level. Financing decision that you were studying in your capital structure theory chapter. Investment is nothing else but it is the capital budgeting decision. Dividend is again the same, that's the how much amount of the earning to be paid in form of dividend, like that. Let us see, these decisions deal with the mode of the financing or mix of equity capital and debt capital. So that is what I told you, capital structure decision. Investment, capital budgeting decision. These decisions involve the profitable utilization of the firm's funds, especially in the long-term projects, that is the capital projects. Since the future benefits associated with such projects are unknown with certainty, investment decisions necessarily involve the risk. The projects are therefore evaluated in relation to their expected return and the risk. Dividend decision. These decisions determine the division of the earning between the payment to the shareholders and the reinvestment in the company. Portfolio decision. These decisions involve the evaluation of the investment based on their contribution to the aggregate performance of the entire corporation rather than on the isolated characteristics of the investment themselves. That is, together you have to see. B question, that is 14B. What is financial risk? How it can be evaluated from point of views? Next. The question is about the financial risk. So friends, over here the financial risk is defined and it is required to be explained from the different point of view. Financial risk referred to as unexpected changes in the financial condition, such as prices, exchange rate, credit rating, interest rate. These are considered to be, like if at all they are changing adversely, that is considered to be the financial risk. Though political risk is not a financial risk in direct sense, but it can be included as an unexpected political change in any foreign country may lead to the country risk, which may ultimately result into the financial loss. Means political risk is also a financial risk. The financial risk can be evaluated from the different point of view. The first is from stakeholders' point of view. Second is from company point of view. And third, it is government point of view. Yes, these three are. From stakeholders point of view, let us see. Majority stakeholders of a business are equity shareholders, and they view financial gearing, that is the ratio of the debt in the capital structure of a company, as a risk, since in the event of the winding up of a company, they will be least prioritized. Means we understand that say higher the debt financing is always considered to be adverse for the equity shareholders. Why? Because the financial risk increases. At our IPCC level, intermediate level, we have studied degree of financial leverage. With the increase in the leverage, with the increase in the committed sources of finance, leverage increases and also the risk increases. Even for a lender, existing gearing is also a risk, since the company is having high gearing, faces more risk in the default of the payment of interest and the principal payment. So what will happen in a situation wherein say you are required to make more payment of the interest, then in that case you are having the more risk. From the company point of view, from the company's point of view, if a company borrows excessively or lend to someone who defaults, then it can be forced to go into the liquidation. From the government point of view, from the government point of view, the financial risk can be viewed as a failure of any bank or like Lehman Brothers downgrading of any financial institution, leading to spread of distrust among the society at large. It shows that say the government was not able to keep the proper track over that bank. We know that say the number of cases are there, like Bank of Maharashtra is one of the recent cases that we have. We know that say number of like the banks who have like the huge NPA, number of frauds are also the examples, and because of that so the government is say having a trouble. Like the recent cases of Mr. Nirav Modi, like Mr. Vijay Mallya, say all these cases are, but that is basically going to create a problem for the government. Even this risk includes willful defaulters. This can also be extended to sovereign debt crisis. Next, third question. Explain various market indicators. Basically, we understand that there are two types of stock analysis that we have. One is fundamental analysis and another is technical analysis. So over here, the question is about the indicators for the technical analysis. The first is breadth index. It is an index that covers all the securities traded. It is computed by dividing the net advances or declines in the market by the number of issues traded. The breadth index either support or contradicts the movement of Dow Jones averages. If it supports the movement of the Dow Jones averages, this is considered to be the sign of technical strength, and if it does not support the average, it is the sign of technical weakness. That is a sign that the market will move in a direction opposite to the Dow Jones averages. The breadth index is an addition to the Dow Jones theory and the movement of the Dow Jones averages. Second is volume of transactions. The volume of the shares traded in the market provides a useful clue on how the market would behave in the near future. A rising index price with increasing volume would signal buy behavior because the situation reflects an unsatisfied demand in the market. Similarly, falling market with increasing volume signal bear market and prices would be expected to fall further. A rising market with the decreasing volume indicates a bull market, while a falling market with the dwindling volume indicates bear market. Thus, the volume concept is best used with another market indicator such as Dow Jones theory. Confidence index. It is supposed to reveal how willingly the investors are to take a chance in the market. It is the ratio of the high grade bond yield to low grade bond yield. It is used by the market analysis as a method of trading or timing the purchase and the sale of the stock, and also forecasting device to determine turning points of the market. A rising confidence index is expected to precede a rising stock market. So you'll have an advanced idea. A fall in the index is expected to precede a drop in the stock price. A fall in the confidence index represents the fact that low grade bond yields are rising faster or falling more slowly than the high grade yield. The confidence index is usually but not always leading indicator of the market. Therefore, it should be used in conjunction with other market indicators. This is a thumb rule that we have that always we should take into account all the indicators together, like candlestick, bar chart, line chart, all of them will be taken together for the purpose of analysis. Simple moving average, exponential moving average, in that also the number of days are different. The relative strength concept suggests that the prices of some securities rise relatively faster in a bull market or decline more slowly in a bear market than the other securities. Some securities exhibit relative strength. Investors will earn higher return by investing in the securities which have demonstrated relative strength in the past, because the relative strength of the security tends to remain undiminished over the time period. Relative strength can be measured in several ways: calculating rates of the return and classifying those securities with the historically high average return as securities with high relative strength is one of them. Even ratios like security relative to the industry and security relative to the entire market can also be used to detect relative strength in a security or an industry. Odd lot theory. This theory is contrary opinion theory. It assumes that the average person is usually wrong and that a wise course of action is to pursue the strategies contrary to the popular opinion. The odd lot theory is used primarily to predict tops in the bull market, but also to predict the reversal in individual securities. Next question. Discuss the problems faced in the growth of securitization of instruments in Indian context. The term securitization or debt securitization is a term in which we understand that basically a financial intermediary is raising the funds out of so assets generating the steady cash flows are pulled together, and against that the securities are issued by forming a special purpose vehicle. This is the concept that we have. The question says that over here, that what are the hurdles that we have in this debt securitization or the securitization procedure. So over here the answer is like this. The first is stamp duty, the second is income tax, third is accounting, fourth is lack of standardization, fifth is inadequate debt market, next ineffective foreclosure laws. These are the hurdles that we have in the growth of securitization. Basically over here we understand that the head points are important, and in that you can write in your own language. The first is stamp duty. We understand that basically what happens at this this debt securitization procedure has also say certain transfers. So there is a levy of the stamp duty. We understand that say with the levy of the stamp duty, so this transaction will become expensive, and that is the reason so it becomes a hurdle in the process. Stamp duty is one of the obstacle in India. Under the Transfer of the Property Act 1882, mortgage debt stamp duty, which even goes up to 12%. So it will absolutely that is make the transaction very expensive for the financial intermediary in some states of India, and this impeded the growth of the securitization in India. It should be noted that since pass-through certificate, there are three types of securities basically: PTC, pass-through security, then pay-through security, PTS, then interest only, and the principal only securities. Does not evidence any debt, only able to receivable, they are exempted from that is stamp duty. Moreover, in India, recognizing the special nature of the securitized instrument in some state has reduced the stamp duty on them. Income tax. The taxability issue is not fully resolved. Who is liable to tax is not clarified, and that is what's one of the reason of that is less growth, or it becomes an obstacle for the growth. Taxation is another area of the concern in India. In absence of, so this is important, any specific provision relating to the securitization instrument in Income Tax Act, experts' opinion differ a lot. Some are of the opinion that special purpose vehicle is a trustee is liable to be taxed in representative capacity, then others are of the view that instead of special purpose vehicle, investors will be taxed on their share of the income. That is the mutual fund, insurance houses who make the investment in these kind of securitized papers. Clarity is also required on the issue of the capital gain implication on passing payment to the investors. Accounting, again friends, over here there is a lack of the standardization. Basically there are no clear accounting standard that we have that prescribes, that tells us that how to record these transactions. It is said that it is off balance sheet item, yet there is no clarification that how the accounting entries will be passed. Accounting and the reporting of the securitized asset in the books of originator. Originator means a financial intermediary in our example, say in this entire understanding, is another area of the concern. Although securitization is slated to be an offshore balance sheet, that is off balance sheet instrument, but in a true sense receivables are removed from the originator's balance sheet. Problem arises especially when assets are transferred without recourse. Recourse and non-recourse, there are two types of arrangement are there. Recourse means that say the originator is responsible. Non-recourse means he is not responsible if there is no repayment of the loan, because basically the asset generating steady cash flow means the loan installments. This amount is going to be received or not. For that, say there is an uncertainty. Who is responsible if at all the amount is not received? In case of non-recourse, the investors will have to bear the risk. In case of recourse, the originator will bear the risk. Lack of standardization, again with respect to the procedure, there is no clarification that say what is the standard procedure by which the entire debt securitization process will be executed. Every originator following his own format for the documentation and administration having lack of standardization is another obstacle in its growth of securitization. This is important according to me. Inadequate debt market. This is a practical point. Basically, we understand that say whenever an investor is making investment in this kind of that is security, afterwards whatever the security that say the trader has, the investor has, whenever he wants to sell it in the secondary market, then there is inadequate market participation. The reasons for that are very simple. This kind of instrument are new in the market, so the number of traders are less in the market who are interested to buy this. So if at all the secondary market is lacking for any of the instrument, then in that case, of course, its primary market is going to be affected. If at all I purchase the Infosys equity share today, then in that case I am aware that if at all after a week I want to sell the investment, then in that case I just have to make a call and I will be able to sell that investment. What I want to tell you is that say the market participation is also very much required, and this is what say one of the thing which is lacking, and it is going to be adverse for the growth of the sector. Lack of existence of a well-developed debt market in India is another obstacle that hindrance the growth of secondary market of the securitized or asset-backed security. Ineffective that is foreclosure loss. Somebody who has taken loan is not making repayment of the loan. With that, say the entire all this process will be affected, because special purpose vehicle can make payment to the, that is said to the lender or to somebody who has purchased the investment only out of the cash accrual that say the special purpose vehicle is going to get. Now in this, importantly what happens, that if at all somebody is not making the payment of installment, then whatever the law that we have said to close that account say is very much such that say it becomes difficult for the special purpose vehicle to get the recovery, and this is also going to affect say the entire securitization procedure. For many years efforts are on for effective foreclosure, but still foreclosure laws are not supportive to the lending institution, and this makes securitized instrument, especially mortgage backed securities, less attractive as the lenders face difficulty in transfer of the property in the event of the default by the borrower. Okay. The next question is, explain the methods in which startup firm can bootstrap. Let us see the answer. Here are some of the methods in which a startup firm can bootstrap. The first is trade credit. The second is factoring. And the third is leasing. These are the three methods by which it can go for the bootstrapping. Trade credit means simple, you purchase the goods on credit. When a person is starting his business, suppliers are reluctant to give trade credit. You are new, so nobody is going to give credit to you. They will insist on the payment for their goods supplied either by cash or by credit card. However, a way out in this situation is to prepare a well-crafted financial plan. The next step is to pay a visit to the supplier's office. If the business organization is small, the owner can be directly contacted. On the other hand, if it is a big firm, chief financial officer can be contacted and convinced about the financial plan. So you go to somebody and you tell them that, say, what is your financial plan? You get a faith of the supplier in you, and with that, so you get the credit. Communication skills are important here. The financial plan has to be shown. So what is your future plan is what you are required to substantiate to them. The owner or the financial officer has to be explained about the business and the need to get the first order on credit in order to launch the venture. The owner or the financial officer may give half the order on the credit and the balance on the delivery. The trick here is to get the goods shipped and sell them before making payment to them. So what happens, let's say you try to get the cycle shorter so far possible, so that say before you have to make payment to them, you are able to get the payment from your customers. One can also borrow to pay for the goods sold. However, there is interest cost also. So the trade credit is one of the most important way to reduce the amount of the working capital one requires. This is especially true in retail operations. Second is factoring. In factoring, what happens, let's say basically you will sell your receivable to, let us say, a bank, and you get the on upfront basis the payment. This is a financing method where the accounts receivable, means debtors of a business organization, is sold to a commercially financed a company to raise the capital. The factor then got hold of the accounts receivable, means debtors of a business organization, and assumes the task of collecting the receivable as well as doing what would have been the paperwork. Factoring can be performed on a non-notification basis. Means you do not tell to your customer that say you have appointed a factor. It means the customers may not be told that the accounts have been sold. In addition to reducing the internal cost of a business, factoring also frees up money that would otherwise be tied up in the receivable. So you are not able to reduce the collection cost, administration cost, but you are able to get the funds faster. See, nothing is free. You are required to make the payment of the financial charges in form of interest as you get your funds early. This is especially true for the business that sell to other business or government. There are often long delays in the payment that this would offset. This money can be used to generate profit through other avenues of the company. Factoring can be a useful tool for the raising money and keeping the cash flowing. Leasing. Leasing is once again a very simple method by which you will be able to get the arrangement. Another popular method of bootstrapping is to take the equipment on lease rather than purchasing it. It will reduce the capital cost and also helps the lessee, that is the person who takes the asset on the lease, to claim tax exemption. So it is better to take a photocopy machine, an automobile or van on the lease to avoid paying out a lump sum money which is not at all feasible for a startup organization. Next question. Explain difference between forward contract and futures contract. Now usually when you study derivative, friends, this point is always covered up. That's what is the difference in the forward and futures. Technically both of them are same. Forward contract, in that say there is a forward buyer. In futures contract there is a futures buyer. In both the cases, say there is an underlying asset, there is a price at which somebody is having a contract to buy, somebody is having a contract to sell. If at all the spot price is more than the forward or the futures price, then the buyer will make a profit, seller will incur a loss. If the price is less, then in that case, say the seller will be able to make profit and vice versa. All these things, the basic transaction is same. However, there is a difference in terms of execution of the transaction. Forward transaction is basically, we understand, is an informal transaction. Futures transaction is a from a formal channel. We understand that say it is a transaction which is entered upon through standardized agency. In forward there is no margin, in futures there is a margin. In forward we do not have the marking to mark contract, over here in futures we have. In forward there is nothing like the lot size, in futures we have. There is no restriction on the time period in case of forward, in futures you have. There is no restriction how to settle the transaction, over here the exchange decides that say how you are required to settle the transaction. That is the way we have say these differences in terms of execution of the transaction. That is what we have. Let us read them. This is again an important question, not only from the theory point of view but also to understand the practical questions. The first is trading. Forward contracts are traded on personal basis or on that is that phone or otherwise. It is called OTC, over the counter derivative transaction. These are traded in a competitive arena in a way that say we understand in simple language. It is the National Stock Exchange, Bombay Stock Exchange, New York Stock Exchange, like that say we understand. Size of the contract, there is nothing like the size of contract in case of forward, are individually tailored and have no standard size. Over here there is a concept of the lot size. So that is the number of shares, or in multiple of that only you have to do a trade. That is the amount, and in multiple of that only you have to do the transaction. Futures contracts are standardized in form of quantity or the amount as the case may be. Organized exchange. Forward contracts are traded OTC, over the counter. They are organized exchanges with designated physical location. Settlement, it is mutually decided in case of forward, takes place on the date agreed upon between the parties. So whatever the agreement. While over here futures they mention friends, like in India we have the multi-commodity exchange, in that say they have segregated for a few commodities physical delivery, for a few commodities the difference will be settled. As far as the stock market is concerned, in that say this it is a difference only in India. It is not like this everywhere in the world. So country to country, exchange to exchange, these things differ. Further we understand that say as far as the indices are concerned, it is always cash settled. Futures contract settlement are made daily via exchange clearing house. Delivery date, forward mutually decided, futures as per the exchange. As far as the stock market in India is concerned, it is the last Thursday of every month is the date on which the auto future contract expiry. If it is public holiday, then the preceding day. Forward contracts may be delivered on the dates agreed upon and in terms of actual delivery. Futures contract delivery dates are fixed on the cyclical basis and hardly takes place. However, it does not mean that there is no actual delivery. So it depends upon exchange to exchange. Transaction cost, of course, low in case of forward, high in case of futures. Cost of the forward contract is based on bid-ask spread. Futures contract entails the brokerage fees for the buy and sell order. Marking to the market. Marking to the market means like basically what happens at in case of futures contract, two traders are doing transaction through a standardized agency. Now if at all there are two traders A and B, they have entered into the transaction from National Stock Exchange. 1000 rupees is the price at which A is going to buy the security and B is going to sell the security. Now practically friends, there is a time gap of maximum 3 months that you can have, maximum 3 months. Let us say that on 1st of January, you are doing a transaction, let us say for 27th of March, very near to 3 months, to buy the security at 1000. Now, what do you think that on 27th of March, that is approximately after 3 months, what can be the price? The price of the security can be as high as, let us say, rupees 1500 or it can be 2500 because the time period is huge. Suppose the price of the security is, let us say 1500, and the lot size is, let us say that the lot size is 600 shares. So 500 rupees is the profit which has been made by Mr. A. On per share, 600 is the lot size, 600 into 500, this is the huge profit that A has. Somebody who has profit is never going to go away, is never going to run away. There is a possibility that say the person who has a loss may run away. So stock exchange will not contact Mr. B on 27th of March that say you have incurred a loss and you give that loss to me. Stock exchange is very smart, and it has to be. That's on daily basis they will see that what is the price difference. Whenever the price difference is going adverse, then in that case the trader for whom there is a loss, from that trader the loss is recovered on the progressive basis. That is the way we understand it is called technical language, marking to the market. Futures contracts are subject to marking to the market, in which the loss or profit is debited or credited in the margin account on the daily basis due to change in the price. Margins are not required in forward. It is more like that the faith that both the traders are having. In futures contract, every participant is subject to maintain margin as decided by the exchange authorities. Credit risk, in forward it is more, in futures it is less. In forward contract, credit risk is borne by each party, and therefore every party has to bother for the credit worthiness. So if at all somebody is incurring a loss, then in that case, that is somebody is defaulting, then of course somebody who has incurred a loss will default. Then the person who has made a profit has to sacrifice it. Over here, in case of futures contract, it is a standardized agency. In futures contract, the transaction is a two-way transaction, hence the parties need not to bother for the risk. So this is the way we put an end to the revisionary test paper of November 20. Wish you all the best to all students from Maulin, Kadikar and from the entire Navkar team for your best performance in examination. Thank you very much, all of you.
If you like this video, share it with your friends. Subscribe to our YouTube channel to watch more such videos and learn from our expert faculty members. Press the bell icon to get regular notifications whenever we upload a new video. Download NDI mobile app to get complete CA course online. We value your support. Thank you for watching.